Welcome, everybody. We're really excited to have you here for this Climbing Mount Debt Interest Payments and Changes Are Coming. Are You Ready webinar. My name is Jordan Ben-Shia. I'm the VIN Foundation Executive Director, and we're really excited to bring you this webinar with Dr. Tony Bartels, one of our student debt experts here who lives and breathes this every day and has had severe job security within the last, I would say, few years as things just get crazier and crazier. But we are now actually at the time where student loan repayments are going to be restarting. And we wanted to get on here to kind of answer your questions and get you the information you need. A few housekeeping tips for the webinar. We really encourage questions. So please use the Q&A and put all of your questions in the Q&A. That'll really help us make sure to monitor them and make sure that we get to all of them. Also in the Q&A, you have the opportunity to upvote your question. So if you see a question that you think is really relevant and is similar to something that you have a question about and you want to make sure it gets answered, go ahead and give it a little thumbs up and that will bump it to the top and let us know that multiple people are really interested in this question being answered. Also, when you ask a question, if you can please put in your grad year, because that will help us answer the question more correctly. And that's something that we haven't done in the past, but we think it's going to be helpful this time. So again, we really encourage questions. Go ahead and pop them in the Q&A. We will be answering them throughout the webinar, and then we have a majority of this webinar set aside just to go through your Q&A and your questions. We have had, as I said, over 1,800 people that have registered, and I see that some questions are coming through the chat. Please go ahead and put those in the Q&A. We want to leave the chat for any technical questions or any technical issues. So let's put the technical questions and issues in the chat, and let's put all of the Q&A in the Q&A. Again, we really recommend that you ask those questions. You have a great resource here in Dr. Tony Bartels, and you are also able to ask anonymously. As I mentioned before, you will all be getting a recording of this webinar, and you'll be getting an email within the next couple of days from studentaid.gov. So make sure to keep a lookout for that. And without further ado, one question we had is, where is the Q&A? It's at the bottom of the screen. So you should see mute, video, participants or attendees, and then you should see a Q&A right there. And just click that, and then you have the option for anonymous and the upvoting, and just make sure that you put your grad year in with your question. Okay, and with that, I'm going to hand it over to Dr. Tony Bartels. Go for it, Tony.
Great, thank you, Jordan. Thanks everyone for joining, and thanks to everybody who submitted those what we call the primary concerns as part of your registration. I've been going through those and have been working a lot of that content into some of the presentation today. I saw a lot of questions about people who have been in repayment for a really long time, wondering what relief options are out there, and you're in luck because I think you're going to like some of the things that we talk about this evening. But I also saw a lot of questions about public service loan forgiveness, which I guess I was not anticipating. So I do have some public service loan forgiveness slides in here. We can definitely go through that. And if you have some questions specifically about public service loan forgiveness, we can tackle those as well. But yeah, everything and anything tonight, I mean, designed to hopefully get you the answers that you need. Now, we do have a ton of information to cover, right? There's been a lot of changes that have been happening, and for a lot of you, particularly recent grads, this is all new, right? So getting started in repayment, since loans have been off largely for more than 3 years, is going to be a whole new experience. And then for many of us, having it be shut off for so long, we kind of forgot how this works. And oh, by the way, they're changing a lot of how it works as we're getting started here. So we're going to try to touch on all of the aspects of student loans, how to work through your circumstances so you can make sense of this stuff, show you where you can get some help, right? So we've been, Dr. Rebecca Mears and I have been answering tons and tons of questions over on the student debt message board area for VIN and VIN Foundation. And that's where a lot of this information has come from. There's a lot of great questions that have been asked in there already. We're seeing people receive forgiveness under the one-time forgiveness count adjustment, which is super exciting. We're also seeing people receive forgiveness under public service loan forgiveness. So there's a lot of things to be excited about, but we also have to work through, kind of like we do with our complex cases in veterinary medicine. We kind of have to take a step back, do a physical exam, and see what our patient is telling us. And in this case, you guys are the patient, right? So we're going to show you how we do those physical exams of student loans at VIN and VIN Foundation, and then answer your questions that you're seeing, hopefully while you're doing some of these analyses while we're going through this material. So I'm going to dive in, and I'm going to try to get through some of this content as quickly as I can and leave as much time as possible for your questions and answers, and we'll do our best to answer them using the Student Debt Center tools and our knowledge of those particular cases. All right, so we're going to look, and this is primarily going to, and this is why I put this one up here. If somebody specifically said, I have questions on all types of forgiveness, periods of time needed, and income-driven repayment options for graduate student loans. And that's a great point, and I'm happy that somebody pointed it out, because this is really specific to, this material is really specific to anyone with graduate school student loans. Right now, anybody who borrowed from veterinary school automatically has veterinary school or graduate school student loans, right? So being a veterinarian puts you in that category. But if there happens to be anybody here that only has undergraduate debt, the rules are a little bit different, right? And we're really not going to spend a lot of time or any time on that aspect of student loans and repayment. This is all of the content that we're going to cover tonight is specific for veterinarians or those who have graduate school student loans. And that's going to encompass direct loans, direct grad plus loans. If you also have loans from undergrad that fall into that direct subsidized loan category, you'll see those when you do your physical exam of your student loans. If you graduated or you were in higher education at any point after or before July 1st of 2010, you may have some of these older federal family education loans, right? And those have been a real sore spot in the history of the student loan repayment system. But really good news, there's a way to take care of those and also still make them eligible for forgiveness. But the first step is identifying whether or not you have them. And one of those key ways to know that is just based on your graduation year, right? If you were in higher education at all using federal student loans 2010 or before, you may have these federal family education loans in your portfolio, and we'll show you how to identify those. We've got some examples of how to find those. Perkins loans, another type of federal student loans that's been floating around out there, but they were discontinued in 2018. I still see them quite frequently show up in folks' student aid data file. Health profession student loans and loans for disadvantaged students, those are also a type of federal student loan, but they don't show up in your student aid data file. So they're a little bit more cumbersome to just make sure that you account for them. But again, good news, you can consolidate them and make them eligible for all of the benefits, income-driven plans, public service loan forgiveness, the forgiveness options that are currently floating around out there. But you do have to find them and then consolidate them using a direct consolidation loan. Private loans are going to be anything that doesn't fall into that category, right? So those are loans that usually have a bank name associated with them. So Wells Fargo or Bank of America or Sallie Mae, something that indicates that it's from a private institution. Those are going to have more limited repayment options. I saw some questions in the submissions for the registrations asking, what do I do with my private loans, or if I've got both federal student loans and private loans, how do I navigate that? Well, you're going to have to take care of them separately, right? So I would recommend that you do that, because your federal student loans are going to be the most beneficial student debt that you're ever going to have, and they have a completely special set of repayment options and strategies associated with them. But your private loans are going to be fairly rigid in their repayment options, right? That's usually going to be dictated by the amount, the interest rate, and the amount of time that you have to pay back that loan, right? So your options there are pretty limited, and are only really fall into kind of a refinance realm, if you will, right? So changing that private loan for another private loan that ideally would have better terms and conditions than your current one. But we want to separate those two out, right? We don't want to treat them together because they're going to have different repayment options and different repayment strategies. If you've lost track of anything, grab a credit report, right? I still think they're letting you check this once a week for free. Normally, before the whole pandemic stuff blew up, we had the ability to check our credit report once per year without having to pay for it, right? You'll also receive a copy of that credit report if you're, going through a financing of a home or a practice or a car. You'll usually receive some kind of report of your credit history and score as well. But you can request it at least once a year for free, which everybody should be doing. But I still think they're letting you check it once a week for free. So when it comes to our federal student loans, they've been off for more than 3 years. March 13th, 2020 was when the forbearance benefits started, and that shut off interest, it shut off payments, and thankfully, it also provided credit towards forgiveness. And that was another question that came up quite frequently in the submissions for the registration was, did this time that I haven't been making any payments, did it count towards forgiveness? And the answer is yes. Right? You didn't have to make a payment. So there's a lot of confusion. I still see that floating around out there where people think that they had to actually make a payment in order to be eligible for forgiveness credit during the pandemic forbearance period, and you don't, right? So you were receiving forgiveness credit for that entire forbearance time, regardless of the repayment plan you were using. The exception is grace periods and in-school time, right? So you don't get any credit for grace periods and in-school time. Right? So if you're graduated into the forbearance period, which many of you probably did, you're not going to start getting credit for forgiveness until after that grace period would have ended. Or if you consolidated your loans and ended that grace period, then you would have started receiving credit after that consolidation was processed. So interest is going to start back up September 1st. Payments are going to resume in October. Right? The date's going to be a little bit different for everybody. You should start to see some statements from your loan servicers showing you what that payment is going to be. And largely that's going to be determined by whatever your payment was coming into the forbearance benefits if you were already in repayment, or if you graduated during that forbearance period, what you did with your student loans. Right? And if you didn't do anything, then your loans are going to be put into the default repayment plan, which is the standard 10-year repayment plan. Right? So that's just logistically what we expect to happen just in the next couple of months, right? Interest is going to start accruing on September 1st. You're going to get a statement from your loan servicer that shows you what your loan's condition are, what repayment plans they're in, and what the minimum monthly payment's going to be in October. If you made a payment during the forbearance period, right, because maybe you thought you had to in order to receive some kind of forgiveness credit, you can request a refund of those payments. Any and all payments that have been made, whether you are making them or maybe an employer was making them, you can request a refund of any payment that was made to a federal, one of these loans here, these direct loans, particularly federally held direct loans, from March 13th, 2020 through the end of the forbearance period, which is pretty much the end of August. Right. So if you could otherwise benefit from using those funds in other areas of your financial wellness, or if you're on a track to reach forgiveness, income-driven plan forgiveness, the one-time count adjustment forgiveness, public service loan forgiveness, all of those types of forgiveness imply that you probably shouldn't be making payments when they're not due. So request a refund. This is a super huge benefit that we're probably never going to see again, right? So to be able to request a refund of payments that have been made to a prior loan to get those funds back is an amazing opportunity. Now, they will add that amount back to your loans, right? You don't get to keep the money and erase the student loans, but if you can use those funds for something else, or you're otherwise on a track to reach forgiveness, then I would highly encourage you to request a refund of any of those payments that you've made from March 13th, 2020 through the end of the forbearance benefit. I see a question related to this from an anonymous attendee. Can you request a refund from a private loan servicer if you kept paying through the pandemic? So if it's a private loan, then no, right? The ability to request a refund is a law that applies only to federally held student loans, right? So all of these direct loans are federally held student loans. Some of these federal family education loans are federally held student loans, but you can only request a refund from those federally held student loans. Now you would request that refund from your loan servicer, right? And I see a lot of confusion. You know, I've got federal student loans, but my loan servicer is, you know, AidVantage, and they're a private company, right? But they're actually just managing your federal student loans, right? So if your loan servicer is AidVantage and you made payments during the forbearance period, you're going to call AidVantage and say, I'd like a refund of those payments that I've made during that forbearance period to my federal student loans, right? So again, it kind of comes back to differentiating what federal loans do you have, which ones that are in this federally held category versus true private loans. What is the deadline to request a refund for the money paid during the federal forbearance? That's a great question. I don't know. I suspect it's going to end when the forbearance benefits end, but I have not seen any language that states one way or another. Right, so if you are going to request a refund, I would highly recommend that you do it before the end of August, right? Because at some point they're probably going to say, sorry, we can't process that request anymore. I just don't know what that date is going to be. So I wouldn't flirt with it for too long. All right, so these are the types of federal student loans that you'll find in your student aid data file, right? So studentaid.gov, whoop, hold on. Didn't want to do that. Sorry if that made you a little bit nauseous. Federalstudentaid.gov, if you've never been in here before, this is kind of the, we'll call it the minimum database, if you will, for your federal student loans. But if you haven't been here for a while, or you've never been here, or it's been a long time since you've requested aid, you can create a username and password in this system. Many of you probably already have one, right? So we can log in here. And what we're looking for is our student aid data file, right? So that file is going to have all of your higher education borrowing history. So hopefully this will come through relatively quickly. It did. And the reason why we recommend you grab the file is it's kind of a check on your loan servicers, right? All the loan servicers do everything a little bit differently, but the good news is that the federal student aid data file is consistent for everyone, right? And we can work with the information that's in there because again, it's consistent for everyone, no matter who your loan servicer is. So this will give you kind of a high level overview. This is what my loans look like, the remaining balance of my loans, but this isn't enough information for me to make any decisions, right? So I have to hit the view details button. And it's going to take me to this dashboard page. And I'm looking for this download my aid data. Right now, you might not be able to do that if you're attending tonight on an iPhone and that's the only device that you have in front of you. You need some kind of device that's going to let you click this button and download a TXT file, right? Because that's what contains all of that information that describes the loan types you have, the dates, payments you've made. There's a whole host of information in there that will help determine your eligibility for things like the one-time count adjustment, whether you need to consolidate, if you are eligible for a refund. All of that information is in that file, right? So you can work with that regardless of what your loan servicer tells you or shows you, right? So I'm going to click that download my aid data. It's going to save that text file, TXT file to my device, right? You want to keep it in that TXT format. And then we're going to take it over to the My Student Loans tool, right? So the VIN Foundation My Student Loans tool is freely available. Anybody can use it, but it's designed specifically for veterinarians and veterinary students, right? So this is part of the tools that are available in the Student Debt Center. The My Student Loans is really kind of the starting point, if you will, right? You want to grab that file, upload that student aid data file into the My Student Loans tool, and it'll show you a report, right? And if you've got a VIN username and password handy, or a VIN Foundation username and password, right, you'll be able to save your progress, and it'll give you a link to the student debt message board area where we provide personalized help to veterinarians and veterinary students, right? So all of this stuff is kind of coming together here, right? So if you graduated from school already, I can upload my student aid data file. I've got a few of them here to play with tonight. This one is from a 2018 graduate. Right, and so we've got some checks in here to help you identify certain things that are happening in the student loan world right now. Right, so if you made payments during that period covered by the forbearance benefit, we'll show you, right? And we know this person has, right? They've made some payments towards their student loans, right? So they are eligible to request a refund if they haven't already, right? So that helps to know whether or not we should be reaching out to our loan servicer. Who is our loan servicer, right? We've got that information here. So Nelnet is a loan servicer in this case, right? So we could see our other loan information, right? So this person at one point had some of those older Bell program loans. They don't currently have a principal balance anymore. Maybe they were consolidated or paid off in some other manner. So I'm just kind of looking at the history, scanning through, looking at the different loan dates, right? So I see loans that have smaller amounts in here, which indicates undergraduate loans as compared to graduate school loans, which are a lot higher, right? But I also see a break between borrowing for undergrad and when I started borrowing for veterinary school, right? Which tells me I probably had some repayment time on one of these older loans, which screams one-time forgiveness count adjustment to me, which we're going to talk about in just a few minutes, right? So these are some of the things that I'm looking at when I upload that student aid data file, just looking through loan histories to help you all figure out which benefits are going to help you the most, right? One of the other pieces of information that we're going to spend a lot of time on tonight are these income-driven repayment eligibility options. Right, so you can use whatever time-driven plan you want, but the income-driven plans have some really specific qualification requirements, right? And this is going to show you which ones you're eligible to use. Right, we're going to cover this later, but revised pay-as-you-earn is going to be changed and called Save later this summer, right? But it's not going to change any of the eligibility here, right? If you're eligible for REPAYE, you're eligible for Save, right? Now the older version of IBR, pay-as-you-earn, newer version of IBR, those are all going to become very important in terms of strategically how you want to use the available options that you have going forward, right? So we want to do that initial assessment of our student loans. What are we looking at? Did I make some payments? Who's my loan servicer? What types of loans do I have? What's the history look like? Do I know if I have any payment time on my loans from before veterinary school, if I have them? That's pretty common. I see that a lot, right? So whether it just took a little while to get into veterinary school or you had a break between undergrad and veterinary school, I see that quite frequently. A lot of, time between undergrad and veterinary school just based on the loan history. But then I'm also looking at these income-driven repayment eligibility details to know which options are going to work best. If you're working towards public service loan forgiveness, you'll also see if you've got any accumulated time here, right? So it's another good way to check what's in your file versus what you might see on your loan servicer end, right? So a lot of really good information in here. It's really kind of that initial physical exam that we encourage every veterinary student does on their student loans. So you can just ask, it helps you ask better questions. All right, let's see what we got here. Studentaid.gov or the VIN site gave different numbers when I put the exact same information from my loan and income. Should I trust the studentaid.gov to be correct? So the student aid data file, the file that I went and grabbed from studentaid.gov and downloaded, isn't a real-time representation of your loan information, right? Your loan servicer is going to have that real-time information. The student aid data file can sometimes be off by 30 days or so, right? So if you've made some payments and it hasn't been reflected there yet, or even during the pandemic forbearance, sometimes the refunds haven't been credited back and added to your account. Sometimes the numbers will be a little bit different from what you might see in student aid or on your loan servicer account. But we're really kind of looking for some of that other information that I shared with you in that My Student Loans tool, right? What loan groups, types do you have? Income-driven repayment eligibility, those sorts of things. If I made some payments. So I'm not terribly concerned if the numbers aren't aligning at that moment, but eventually they should be. right? So you may just have to wait a little bit longer or go and grab a newer student aid file to see if it's now reflecting the same information that you're seeing in student aid or on your loan servicer account. All right, what if your loan servicer has changed, but you made payments? Yeah, great question. So you'll see that, right? You'll see who your new loan servicer is. Now, theoretically, all of that information from your past loan servicer should have transferred over to that new one, right? So if you made payments to an old loan servicer, you would still request a refund from the new loan servicer, right? Because they're going to have that history and they're going to be the only one that can process that payment because the old loan servicer is gone. Right. So yeah, that has been happening a lot lately too. So the loan servicers have been changing. So you want to stay on top of that information, right? You want to make sure that everything that your old loan servicer had for you transferred over to the new loan servicer correctly, right? The repayment plan, all of the loans made it. You know, the history that came with your past loans went to your new loan servicer. So those are things that I'm looking for. That happened to me because Great Lakes, they stopped servicing loans, right? So everybody had Great Lakes got moved to a new loan servicer. So now my new loan servicer is Nelnet, and I've had to set up that new account with them, make sure everything looks accurate, and set up my auto pay for when the payments start back up this fall. So all of those are things that I'm doing with that new loan servicer and looking for anything that doesn't seem quite right in that account. All right, so generally speaking, when you approach repayment, you're going to have two main options. They fall into either a time-driven realm, right? So more of a traditional repayment structure, or an income-driven realm, which are unique to your federal student loans only, right? So time-driven plans, you know, here's some of the names of them. You know, the standard 10-year plan we talked about, that's the default plan that everybody's loans ends up in if you don't choose a different plan. You can extend it beyond 10 years to 15, 20, 25, even 30 with a consolidation loan. And graduated repayment plans, basically you start out paying just the interest and the payment increases every couple of years, right? And you can pick different time frames on those graduated scales. Again, 10, 15, 20, even up to 30 if you consolidate your loans. I do see a lot of people in these types of repayment plans, right? So they're generally not eligible for forgiveness credit. However, the one-time forgiveness count adjustment changed all that, right? We're going to talk about that in just a little bit. So you can still get forgiveness credit even for these plans that previously weren't eligible for any kind of forgiveness consideration. So you can, you know, again, these fall into what I consider a more traditional repayment realm, right? So principal, interest, the amount of time sets the minimum monthly payment. And if you make that payment for that duration of time, then you're going to have a zero balance at the end of that time frame. So you can choose to pay your federal student loans back using one of those time-driven plans. All private loans work on some variation of time-driven repayment, right? But it's those income-driven or your federal student loans that only have that income-driven option. Some comments and general thoughts that I see come up quite frequently when it comes to loan repayment. And this is one of these common comments or sentiments, right? They want to pay the least amount of money over the least amount of time. And when you think about that, that's really not feasible, right? If you're going to, you kind of can't have both there, right? In order to pay the least amount, you have to extend the payment for a longer duration, right? On a monthly payment basis, which generally has you paying more interest, right? So you're going to pay more in total that way. Right, so there's really no way to pay the least amount over the least amount of time unless you write a check for the entire loan balance when the first statement comes due, which if you can do that, then you probably shouldn't have taken the loans in the first place, right? So that's generally not a situation that anybody's in. But here's just kind of an example of how these time-driven plans work at various different principal balances, right? So if we've got a $300,000 student loan balance at 6% and I want to pay it back in 10 years, then the minimum payment is $3,300 a month, right? That's what I have to pay in order to pay back that $300,000. And it'll take 10 years and the total cost will be about $400,000, which means I paid about $100,000 in interest in order to do that, right? Loans require interest on a time-driven scale. right? That's the cost of not having the $300,000 up front to pay for that education out of pocket, right? As you're using somebody else's money, they're charging you interest on that. Here's what that cost will be under a 10-year time-driven scale. Right now, that you have to compare that against what the federal student loan income-driven options let you do, right? Because they're going to be very different in what the minimum payment will be, regardless of what your loan balance is. Right. So here's the current options as they exist right now. Right now, there's going to be some shifting here, right? And we're going to talk about that, right? But the other sentiment that comes up with federal student or student loans in general that contrasts with the paying the least amount of money over the least amount of time is this getting out of debt without it taking too long and paying more than I originally owed, right? So again, kind of a competing, mutually exclusive idea, right? It's very difficult to pay less than what you borrowed for any loan, right? Just based on how loans work. However, in the federal student loan system, there are instances where you will pay less than what you borrowed, right? But the only way to do that is through an income-driven plan or public service loan forgiveness, right? So it depends on how you want to approach repayment, right? And what's going to align best with your philosophy and financials and thoughts on student loans. But depending on where you kind of fall here, right, you're going to have to choose a repayment plan that aligns with that, right? Because again, I feel like some people are just, they have an idea of like, I just want the debt to be gone, right? And so, okay, well then you have to write a check for the entire amount now. And that's often not feasible, nor is it necessarily a good use of your money. Right? But we do also have these other options that allow us to pay. It may take a little bit longer, right? But we could theoretically pay less. And in some cases, we may even pay less than what we borrowed, right? That's very common with public service loan forgiveness or with some of the newer income-driven repayment options, particularly with the one-time count adjustment in terms of remaining balance left. All right, so now we're going to kind of bob and weave here through what's changing in the income-driven universe, right? So, and we're going to go into this in a lot more detail, but kind of stay with me right here. Revised pay-as-you-earn is going to be changed, and it's now going to be called Saving on a Valuable Education, or SAVE. Right? SAVE is going to have the lowest monthly payment of any income-driven plan. Right. So if your goal is to have the lowest monthly payment most likely possible, SAVE is going to be one of the plans that you're going to want to look at. Right. Now there's a lot baked into that, right? But it is generally going to be the lowest monthly payment option of any of the federal student loan repayment options. As part of that, they're going to phase out pay as you earn and the original income-driven plan, income contingent repayment. Right, so phase out meaning anybody that's eligible to use those plans currently can choose them and keep using them for the duration of repayment as long as they're in them on that date, July 1st, 2024. Right, so if you're currently using pay as you earn and you think that's the best plan for you, you can keep using it as long as you're in it by July 1st, 2024. After that date, nobody will be able to choose that as their plan going forward, right? So if you're not in pay or for some reason you left pay after July 1st, 2024, you wouldn't be able to get back in it. But anybody that's using it can keep using it, right? As long as they're in it before July 1st, 2024. The old version of IBR 2009, is going to become obsolete, right? SAVE is going to be a better option than the original version of IBR. And that's going to be a huge improvement for those of us who are stuck using IBR, the old version, because we weren't eligible for pay-as-you-earn, and we couldn't use revised pay-as-you-earn, maybe because our spouse earned too much money and we wanted to file our taxes separately, so our payment was based only on our income. Those folks in the past have been stuck with the original version of IBR. I call it IBR 2009 or old IBR, right? The updates to REPAYE called SAVE are going to be a huge lifeline for those folks, right? And it's going to essentially make the old version of IBR obsolete. Right now, not right away, right? It depends on what your minimum monthly payment is now and how long before you have to next renew, right? So there's going to be a little bit of an art and science in terms of when you should transition to save, but after in the next couple of years here, there is no good reason for anybody to still be in the old version of IBR. Save is just going to be a better plan for all of those folks. And then we're also going to see an opportunity for people to use a combination strategy where you can, and this is going to be particularly relevant for more recent graduates, those that are eligible for the new version of IBR, which I call IBR 2014 because it requires you to be a new borrower. Your first loan was received after July 1st of 2014, right? But you can use Save in the beginning and then switch to the new version of IBR so you receive forgiveness sooner, right? And we're going to talk about that in more detail later. But this is kind of what I see as the shifting landscape of the federal income-driven repayment options and the strategies that are kind of overlaying them. All right, so just how do they calculate these payments? Because this is part of the changes, right? Discretionary income, that's the fancy $5 word for the measure used to calculate your monthly payment, right? Discretionary income for federal student loan repayment purposes is your taxable income or adjusted gross income from your tax return minus some kind of allowance, right? So in the past, it's been 150% of the federal poverty guidelines. The new updates to REPAYE called SAVE are going to protect 225% of the federal poverty guidelines as that establish that discretionary income. And then we're going to take about 10% of that discretionary income divided by 12 in order to get a minimum monthly payment. Right. So a few questions that came up in the registration: how long is the time frame for Save? It's the same as it was for REPAYE, 25 years if you've got grad school loans. Right now, that's if you're starting from zero. Right, many of you have already been in repayment. You're not starting from zero. Another really common question is if I switch from one plan to another, or if I've been in REPAYE for 5 years, does that time still count towards forgiveness? The answer is always yes. Right, switching plans does not restart your forgiveness clock. They're giving away forgiveness credit now like candy. Like that one-time forgiveness count adjustment, when we get there, it is crazy how much time you can get for forgiveness credit, even if you've never been in repayment before, right? So you really want to, again, these are the maximum repayment timeframes, 25 years max for Save, the new version of IBR, 20 years, pay as you earn, 20 years, right? So that's the maximum amount of qualifying forgiveness payments you need to make. And if you still have a balance remaining at the end of that maximum time frame, then that's what triggers forgiveness. And so generally speaking, Save 25 years. New version of IBR and pay as you earn, 20 years, right? But then we're going to have different discretionary income formulas. So if we take $125,000 of income, that's the average reported by AVMA in the most recent economic report. I do the discretionary income calculation for Save, right? 2.25 times 14,580. That's the federal poverty guideline in 2023 for a family size of 1. Discretionary income is 92,000. For pay as you earn and the new version of IBR, it's 103,000. Right, so you can see the difference in the monthly payments here. Right, it's not great between Save and pay as you earn or the new version of IBR, but it is different. Right, so it's lower. It's going to generate a lower monthly payment. So how much should?
You might want to expand your screen because it looks like you're showing just part of your desktop. That way, it can be easier for them to see. Yep, thanks.
Great. Cool, thank you. So how much should you pay? I would suggest you start with what the rules require, right? Compare that to what you're paying now, right? How does that stack up against your financial circumstances? Does it give you some breathing room to work on other areas of your financial wellness? And how does that compare to maybe a standard 10-year plan payment? right? In that example of that person who had $300,000 of student debt, who needs to make a $3,300 per month payment to pay it off in 10 years, that's significantly more than what their income requires them to pay, right? And that's where I see people really get into trouble, is when they're trying to pay more aggressively towards a loan balance where their income doesn't necessarily support that, right? And this just helps you establish what that difference is between what the rules require you to pay versus what a time-driven plan might require you to pay. And I see, people kind of get stuck in a tug of war there. On average, people usually tell me that they want to pay something like $1,500 a month towards their student loans, right? In order for you to generate a payment of $1,500 per month using the new SAVE plan, right, you have to have an adjusted gross income that exceeds $210,000 per year, right? So if that's you, great, right? Then that means that $1,500 a month is about the right amount that you should be paying towards your student loans. But the numbers would show us, right, that you're probably not earning that, right? So until you are, don't pay $1,500 a month towards your student loans, right? That's kind of the lesson that the income-driven plans are beating us over the head with, right? You don't have to pay more than your income requires towards your student loan, right? If you want to have some financial flexibility. And then also, strategically, these are the realities, right? So when it comes to now these changes, should I switch to a plan like SAVE from IBR, right? Whether you're using public service loan forgiveness or not, first question begs the question, which version of IBR are you using? If it's the old version of IBR, then yes, right? We just kind of covered that. That's going to become obsolete. And numerically, maybe you can see why, right? That 15% of your discretionary income, now you're at 10% of a lower discretionary income. The difference between that payment and an IBR old payment, right, is pretty significant. And if you're working towards public service loan forgiveness, your goal is to pay the absolute minimum your income requires towards your student loans so you can have the maximum amount forgiven, right? So you want to definitely run into a plan like SAVE. So you have a significantly lower monthly payment, you'll have more funds in your budget, you'll have more forgiven. Right, so that's how we're kind of tracking through the various options and how those strategies will play into our finances. All right, so I'm gonna come over to the Q&A panel here, just looking at some of the questions that are coming in related to this. Does the income-driven repayment plan account for cost of living in different areas of the U.S.? Unfortunately not, right? So the poverty guidelines cover the lower 48 states, and then there's a separate one, a higher one for Alaska and Hawaii, right? So anybody who's in the lower 48 states, that poverty threshold is the same. Now it changes based on your family size. The higher your family size, the higher the poverty threshold, right? So that 14,500 was for a family size of 1. If you're a family size of 3, it's something in the 20s, right? So it goes up based on your family size. But no, it doesn't take into account different cost of living areas. That's one of the common complaints with the discretionary income formula, that it doesn't adjust for variances in, say, San Francisco versus, Ames, Iowa, right? So, but it does allow you to protect a decent chunk of your income, particularly in SAVE, just based on how that poverty guideline multiplier is applied. If you have had forbearance for any other reasons besides COVID, are you ineligible for loan forgiveness? Oh, so let's save that one. That's a great question for the one-time count adjustment, and we're almost to that section. How do I know if I'm an old or new IBR? I borrowed in college, but I think those subsidized loans are with a different service. So that's a great question, and that's where I'm going to send you back over to our student loan exam. Right, so if you grab your student aid data file and upload it into the VIN Foundation My Student Loans tool, and I go to the income-driven repayment eligibility tab, I am going to see that information. Right here, it tells me this person is eligible for the old version of IBR. right? And then I can look and see which one are they using. They are using the old version of IBR, right? So I'll see that in the repayment plan information under any of the loan groups or loan types. If I hit the show details, the repayment plan will be listed in that file, right? So IBR 2009, I just showed or shared with you that that's going to be an obsolete plan. Now, here's where you may not want to run away from it just yet. And this kind of jumps ahead to when I was going to use this particular person as a case, right? But their minimum monthly payment is $446 under the old version of IBR, which is quite low, right? And if their income has increased over the last 3 or 4 years since they established that monthly payment, then they're probably going to want to wait until they have to renew their income to switch over to save so they can preserve this lower monthly payment, right? Because otherwise their payment might go up significantly to reflect their current income. And you can kind of pause that based on how they have set the renewal dates for people who are using income-driven repayment plans during the forbearance benefit period, right? But now we're kind of jumping ahead. But that's how you can look for your own student aid file. Go grab your student aid data file, upload it into the VIN Foundation My Student Loans tool, right? Look at the income-driven repayment eligibility tab, and then look at either the loan groups or loan types. Hit the show details, and you'll see the repayment plan information in there. All right. Is there any concern of future presidents messing with SAVE? I am on IBR 2009, and I like that it's in law and maybe harder to mess with by future presidents. So that brings up a couple of really interesting concepts. So yes, we can see future administrations change plans, right? Just like pay as you earn was created, just like revised pay as you earn was created, just like they're now changing repay to save, right? You do have the security that IBR is in law, right? They can change how they execute it, but they can't get rid of it, right? But if there's a better plan for you to use it, right? Don't stick with IBR 2009 when there's a better plan to be used that may not go away, right? It may be there for the duration, or it could be 5 years from now, there's a plan that's even better than save that makes sense for you to switch to again, right? So I would not stick with the old version of IBR just because it's one of the more secure ones, right? I'm going to use that newer version because, again, in the simulations that we've run, save is significantly better than the old version of IBR. So even if you only get to use it for a few years, that few years is still going to save you a significant amount of money compared to IBR, right? So they can tinker with some of the things, but the idea that I'm not going to use save because they're going to change that or take it away, and then I'm going to lose all my forgiveness credit. That's not realistic, right? They may change save or, maybe make it not as beneficial, but chances are it's going to be better, or something available is going to be better than the existing version of the old version of IBR. So I'd really encourage you to run some numbers and think about switching away from that older plan. How do you find your student loan data file to upload? All right, I will come back and do this one more time here. So we're in the studentaid.gov universe, right? Studentaid.gov, I'm logging in, right? Let's see if it'll send me another code, right? So it's going to send you a code, right? And if you don't have a credentials, you'll have to create your login. But if you have or had federal student loans, it'll let you create a username and password in this system. It may take a couple of days if it's been a long time since you've been exposed to that system. Right, so I'm going to log in here, and it's going to show me my summary of my federal student loans that are remaining. Right, so I need to hit this view details button, and it's going to take me to the dashboard. And I'm looking for this download my aid data link, right? If I click that and hit continue, it's going to ask me to save this ugly looking text file to my device, right? And that's the text file that you're going to come over to the VIN Foundation My Student Loans tool and upload.
And Tony, if you can show them where that is again, because we're getting lots of
Sure.
questions for that.
Yeah, sure. So I'm gonna come over to vinfoundation.org/student debt center, and I'm gonna click on My Student Loans, and I'll show you what the page looks like before you upload a file. Right, so this is what the page looked like clean. Right now I'm logged in because I've logged in with my VIN username and password. Right, so if you've got a VIN username and password or a VIN Foundation username and password, you can log in here. Right, and it'll save your files that you upload, but it also gives you a link to that student debt message board area where we do these personalized evaluations. Right, but here's where you're going to want to upload that file. Right, if you're a student, you're going to click this middle box. If you've not started borrowing yet, you just want to play with cost of education, you can do It's Cool Loan Estimator. But if you're in repayment, you're going to use this one on the right. Right, I'm going to upload my data file. Here's another one that I have. This is a 2023 graduate. Right, $262,000, no unpaid interest, right? That's been one of the really huge benefits of that pandemic forbearance. The loan interest rates have been shut off for more than 3 years. There are a lot of veterinary students who went through vet school and didn't accrue hardly any interest. Amazing, right? Did make some payments towards their loans during that forbearance benefit period, right? As we talked about, may want to request a refund of those while that benefit is still in place. I'm looking at the income-driven repayment eligibility. This person is eligible for pay-as-you-earn, revised pay-as-you-earn, which is going to become SAVE in just a couple of months, the new version of IBR, right? So you're either eligible for the new version of IBR or the old version. You can't be eligible for both. It's determined by whether or not your first loan was received after July 1st of 2014, right? So if I come over here and look at this person's loan details, right, the earliest loan I see in here is 2019, right? So they only have loans from veterinary school, right? So that makes them eligible for the new version of IBR, right? If they had a loan, any loan, federal loan from before July 1st of 2014 for any reason, right, they would not be eligible for the new version of IBR, and they would fall into the old version of IBR category. All right, cool. Any other questions on that? All right, we're gonna kind of blow through forgiveness here, and this is where we're going to talk about public service loan forgiveness. So if you got questions specific to public service loan forgiveness, just, warm those up, right? That's going to be where we're going to touch upon this in the context of some of the changes and what to know in terms of setting yourself up for public service loan forgiveness. But public service loan forgiveness and income-driven repayment forgiveness are two different things, right? So we've got the type of forgiveness that you can be eligible for by using an income-driven repayment plan. Right, so you make payments based on your income using a plan like pay-as-you-earn or IBR or SAVE. And if you have a balance remaining after you reach this maximum repayment period, that balance is forgiven. Right, whatever the remaining principal is, if there's any unpaid interest, that balance is canceled. Right, so you'll get a 1099-C in the mail that year that you reach forgiveness that reflects how much debt was canceled on your behalf. And you may or may not have to report that as income when you file your taxes that year, right? So currently, there is an exemption for anyone who receives student loan forgiveness, a special exemption unique to student loans. Any student loan that's forgiven for any reason between the tax years of 2021 and 2025 will not be taxed at the federal level, right? There is the one-time forgiveness account adjustment, which I keep talking about, we haven't got to the details yet, is going to trigger and already has. We got a release last week that 800,000 people have received a letter that they're eligible for forgiveness, right? They're going to receive student loan forgiveness in 2023 tax year, which means they will not have to pay tax at the federal level for any amount of student debt that's canceled in the 2023, or if it happens for them next year or the year after, there will be no tax. Right now, it's going to be up to Congress to determine whether or not they want to extend that tax exemption specifically for student loans beyond 2025. Right, if they can't get their act together, what will probably happen is whatever the existing law is in place, they'll just extend it, right? So it might get extended for another 5 years. Or if they've got a real bug up their butt, they may say, we're not going to do that anymore, right? We're just going to erase that tax exemption, and anybody who receives forgiveness after 2025 will have to pay federal income tax on whatever amount of student debt is canceled. Kind of have to wait to see on that, right? But it's super exciting for anybody that's going to, and there's going to be a lot of people, and some of them are veterinarians we've already heard from that have received the notice that their loans are going to be forgiven. They're not going to have to pay any federal tax on their student loan forgiveness, right? Now that's separate from public service loan forgiveness, right? Public service loan forgiveness is determined by your employer, right? So if you have federal student loans and you're working for the right employer at least 30 hours per week on average, and you're using the right repayment plan for that student loan or for those student loans, you're earning public service loan forgiveness credit. Right? It requires you to reach 120 monthly qualifying payments for at least 10 years of public service credit to be eligible to apply to have your loans forgiven. Right now, no matter when you receive public service loan forgiveness, it's going to be tax-free. Right? Public service loan forgiveness has a special tax exemption that does not require it to be 2021 or 2025, right? No matter when you receive public service loan forgiveness, it is going to be tax-free at the federal level, right? So if you're not earning public service loan forgiveness credit and you think you should be, then submit the public service loan forgiveness employment certification form. But you could do that electronically if you can find your employer in the database that's on the public service loan forgiveness website, right? Or there's a manual form that you can fill out that part of it you complete, part of it your employer completes. You submit it to the Department of Education, and they'll tell you whether or not you're doing the right things and assign you the qualifying number of payments for public service loan forgiveness. Right? And as you're tracking your progress, when you reach 120 months, that's when you can apply to have your loans forgiven. But if you're not submitting that employment certification form, you won't see that tracking of your progress, right? And unfortunately, I don't have a file that shows that progress. But if that data is in your file, indicating that you have submitted an employment certification form and received some credit, you'll see these numbers increase, right? And it's a way that you can track on your end how close you are from receiving public service loan forgiveness. Right, let's see if we have some. Can you be hired as a part-time at a qualified employer to qualify for public service loan forgiveness? You can now, yes. And as long as you are working at least 30 hours per week, either with that employer or with a combination of qualifying employers, if you can piece together at least 30 hours per week at a qualifying organization, then you are meeting the requirements for public service loan forgiveness. Right? It doesn't have to be with a single employer. Right? The key is the 30 hours per week at a qualifying employer, which is generally a 501c3 or any other kind of government entity. Right? So if you're working for the USDA, or you're a state veterinarian, or you're working for an academic institution, you're working for a shelter that's a 501c3. I mean, there's a lot of opportunities, nonprofit organizations that are hiring veterinarians, or even if you're working part-time for a couple of them and piecing together at least 30 hours per week, you can reach public service loan forgiveness. Are there state taxes for public service loan forgiveness? I don't believe so. I'm pretty sure that is exempt at the state level as well, right? But with all of the other forgiveness opportunities that have been popping up recently, there's been some question as to whether or not all of the states exempt student loan forgiveness from being considered taxable. But I believe that if it happens under public service loan forgiveness, I think the states will exempt it as well. But that's something I would have to confirm. Can non-vets also use the VIN Student Debt Center? Absolutely, right? But if you have only undergraduate loans, be careful, right? All of the configurations in the VIN Foundation Student Debt Center are designed specifically for veterinarians and veterinary students who have grad school loans, right? So if you have grad school loans, then it'll all work fine for you, right? But if you have all undergrad loans, it's not really configured for that, right? So just be careful. There are some differences between undergraduate repayment rules and graduate school loan repayment rules. Let's see. All right, let me see if I had anybody else see any more public service loan forgiveness questions.
Yep. Can you qualify for PSLF if doing an internship followed by a residency at a public university that qualifies?
The internship, absolutely. The residency, I think you should, but it depends on the residency and it depends on the school and it depends on the person who's signing off on your position there, right? So with the changes that just took effect July 1st for public service loan forgiveness, it should be easier for you to get some sign off on those residency positions when it comes to public service loan forgiveness. But print out that form, take it to however the overseer of your residency program is, or the equivalent of the HR director there, and see if they'll sign off on that for you. The internship you should have no issue with, but the residencies sometimes can be complicated, particularly if there's a school component and how they classify you in their system, but you're definitely working more than 30 hours per week, right? And all of the academic institutions are 501c3, so you should have no problem meeting those requirements. It's just whether or not you can find somebody there that is willing to sign off on that.
Okay, we have another one. I'm pursuing PSLF and wondering if September is counted as a zero payment month, or if I have to schedule a payment for that month to count toward PSLF grad year 2014.
I would not schedule a payment, right? You shouldn't have to schedule payments for any reason, right? So payments resume in October, right? The forbearance benefits end September, right? All of the forbearance benefit time, provided it overlaps with your employment time at that qualifying employer, will be public service loan forgiveness eligible, right? As long as you are meeting those employment requirements, right? The average 30 hours per week and it's a 501c3 or other qualifying entity, right? That forbearance benefit time is all going to count, regardless of the plan that you used, repayment plan that you used. But you will have to get back into, and I'm not sure if you've been doing this or you're relatively new to this, but we're all going to have to kind of get, back in the saddle, if you will, of using the right repayment plan. We still have a little bit of grace period, but after the end of this year and after the one-time forgiveness count adjustment is applied, everybody's going to have to start getting refamiliarized with the income-driven plans. Right, there's been a lot of waving of magic wands and hey, any repayment time or any loan type, whatever goes when it comes to meeting these requirements, right? But at some point, those requirements are going to come back into effect, right? It's going to be sometime next year, right? So you still have some time to familiarize yourself with that, but ideally, particularly from a public service loan forgiveness standpoint, you want to make sure you're making the absolute lowest payment possible, right? So if you've got a zero payment, great. If you don't have to make a payment, like we haven't had to make a payment during the pandemic forbearance benefit, great. That still counts, right? But when it gets to the point where you're going to trigger a payment, right, make sure you're paying the absolute least that's required based on the rules, which is probably going to be using the new SAVE plan, using your taxable income as your, in the discretionary income formula we talked about, and making sure you're logging that progress by submitting that public service loan forgiveness employment certification form.
Okay, as a reminder, please put your questions in the Q&A window and not in the chat. That'll help us make sure that we're getting all of them answered. Here's another PSLF, a 2021 grad here. Is there a way to retroactively get forgiveness for a period of time during the forbearance period that I started working in public service, but had not established PSLF payments because I don't think $0 payments would count for anything. Question.
It's a great question. We've kind of heard that a lot about not thinking that the $0 payments would count for PSLF.
So the $0 payments count, right? I do see a lot of people concerned, and I've seen other people recommend that you make payments when your payments are zero to make sure that they count. Zero payments in an income-driven plan or during the pandemic forbearance period count towards forgiveness, period, right? There is no question as to whether or not that is true, right? There's no reason to make payments that aren't due, right? So if you made payments thinking that was a requirement to receive public service loan forgiveness credit, request a refund of those payments. What's going to determine whether or not you receive public service loan forgiveness credit is if you have direct loans in a repayment status, right? It's not going to work while you're in school, or it's not going to count when you're in the grace period, right? It's not going to count when you're in an in-school deferment, right? But if you are in any other status on your direct loans and you are averaging at least 30 hours per week at a qualifying organization, you will receive forgiveness credit and public service loan forgiveness credit if it was while you were working for a qualifying organization. Right? You do not need to make payments that are greater than zero to receive public service loan forgiveness credit. In many cases, you can have an income that will set your payment to $0 per month, right? So that's why the $0 payments count when it comes to forgiveness credit.
Okay, another one is, so requesting a refund to payments made during forbearance won't reset my clock for PSLF.
Absolutely not. Yeah,
Okay.
absolutely not. Requesting a refund will not reset your public service loan forgiveness clock, right? The law that set the forbearance benefits specifically says that you will receive forgiveness credit for that time that you spent in that forbearance period. Right now, when it comes to public service loan forgiveness, you still have to be checking all of these other boxes, right? You don't automatically get public service loan forgiveness credit unless you're meeting those average 30 hours per week with that qualifying organization.
What if you're one of those people that have graduated into the pandemic forbearance, never done anything with your student loans, haven't had any payments or anything like that? Has that time been counting towards this credit that we're discussing here?
The time would start, it depends on when you started working for that qualifying organization and when your grace period ended, right? So normally your veterinary school loans have a grace period of 6 months. So if you graduated in May and your grace period ended in November, but you started working for a public service organization in June, right? You would not be eligible for that credit until November when your loans were officially out of the grace period.
So for an IBR 10-year PSLF, when the remaining loan is forgiven, is that sum taxed? If it is taxed, roughly what is the percentage taxed?
Say the beginning of part of that one again.
Mm-hmm. For IBR / 10-year PSLF, when the remaining loan is forgiven, is that sum taxed? If it is taxed, roughly what is the percentage taxed?
So we're talking about public service loan forgiveness.
Yeah, but they start, it's anonymous, so I don't know who asked it.
Yeah.
It starts by saying for IBR / 10-year PSLF, when is.
Yeah, so that, there's a lot in there, right? So yeah, if it's public service loan forgiveness, it's not taxed.
Right.
Right. If it's under an income-driven plan, it's not taxed if the forgiveness is received between 2021 and 2025. Right. But if it's received beyond then, it could be taxed at the federal and state level if you have a state that charges you income tax, and that's going to be determined based on your income, tax filing status, tax rates at the time. Ballpark, I would say, I mean, if you're like, when we do simulations and we're trying to project what forgiveness is going, a tax might be for somebody who would have to pay a tax, so not public service loan forgiveness, we're generally ballparking, 30%. Now, if you live in a state that has a higher income tax and you're going to have a lot forgiven, you may want to bump that up. Right? But it's going to depend on what your tax rates are, what the federal income tax rates are, what your income is, tax filing status, and all those specifics that go into calculating your effective tax rate.
Do you want more
Okay.
PSLF questions, or do you want to start scrolling through?
Yeah, we can start scrolling through. I just wanted to show
Okay.
too, and this is a letter that one of our colleagues received, had $440,000 of student loans canceled under public service loan forgiveness and the temporary expanded public service loan forgiveness, which was another one of those kind of do-overs, right? Because the initial version of public service loan forgiveness didn't go so well, right? So the temporary expanded public service loan forgiveness was the first attempt to expand that to help capture some of those folks who didn't make it the first time, right? And then we had the limited waiver, which opened it up even more, right? And now we've got the changes that took effect in July that adjusted the hour requirement to make it more flexible, right? And just from the limited waiver, there was 42 billion canceled for 615,000 people, right? So all of this stuff is happening, right? If you're doing the right things to make sure that you're staying on track with it and meeting those requirements that at least public service loan forgiveness requires. Okay. Let's hit the one I've been threatening to cover here for a while. So the one-time count adjustment. So this one-time forgiveness count adjustment, I mean, as much as we all wanted to kind of see the Supreme Court allow the cancellation benefit go through, right? So to cancel $10,000 or $20,000 of student debt, this one-time forgiveness count adjustment is worth way more, particularly for anybody with graduate school loans, right? So it's really hard to overstate how big of a deal this is, right? So anytime, this is one of these magic wand things again, right? Any student loan that was in any repayment plan is eligible for forgiveness credit. Even certain periods of deferment and forbearance are eligible for forgiveness time, right? So you can add all of that up based on your loan history, right? So I grab that student aid data file, I upload it into my student loans. I'm looking at the oldest loan in there. How long has it been in repayment, right? If I need to, and I consolidate that with my remaining loans, it will take that time on the oldest loan and take that repayment amount of time and transfer it as forgiveness credit to that new consolidation loan, right? So huge magic wand, right? I've got, if I've got a loan from 1999 that I started paying on, and I took 10 years off before I went to veterinary school, and now I've got veterinary school loans, and I consolidate all of those veterinary school loans in with that loan from 1999 that's got 10 years of repayment time on it, I'm going to increase the forgiveness eligibility, the forgiveness time of my veterinary school loans by 10 years. Right? That's what the forgiveness count adjustment does. So the closer you get to 20 or 25 years, 25 years if you have grad school loans, the sooner you're going to reach forgiveness. Right? So this highly encourages you to look at your student loans. If you've got any kind of messiness, right? If you've got loans that you left out of a previous consolidation, if you've got some of those older school Pell program loans, you've got health profession student loans or Perkins loans, you can consolidate them all together. And the loan that has the highest amount of repayment time is going to receive, that consolidation loan is going to receive that number of years of forgiveness credit when the count adjustment is applied. And this is what's been happening recently when it comes to the forgiveness count adjustment, right? We've just got a release in notifications of people who have been in repayment for 20 or 25 years receive this notice, right? Hold on, I'm going to come back. I got lost in my Zooms here. But if you received an email that looks like this, your loans are going away, right? This is the forgiveness letter. right? So if you haven't received one of these and you're a person who has some older loans or you've been in repayment for a number of years, right? Consolidate your loans and make all of those loans eligible for this one-time forgiveness count adjustment. So you get the maximum amount of forgiveness credit on those loans, and you may be done with student loan repayment sooner than you realize. Right. So this is again, it's really hard to overstate how big of a deal this is. Right. So you can be done with your student loans if you've been making steady payments or even had your loans in deferment or forbearance for a little while. That will count towards forgiveness under this one-time count adjustment. Right. So we're looking at, these were some of the concerns that people submitted, right? I graduated in 2001, $110,000 of student loans left, not using an income-driven plan. That's okay, right? You've got 22 years at least of qualifying forgiveness time if you put yourself in a position to receive that one-time forgiveness count adjustment. The thing that I don't know from this information is what type of loans do you have, right? That's why you have to do that physical exam of your student loans, right? I suspect that these are all of those older FFEL program loans. If you consolidate them into a direct consolidation loan, you'll get at least 22 years of forgiveness qualifying credit, which means you're 3 years away from receiving forgiveness. In this particular case, just based on this limited information that I have. Here's one that's been repayment since 2000 at least, right? Only paid $10,000 on the principal. Screams one-time count adjustment, right? That's 23 years of forgiveness qualifying credit. You're 2 years away from having your loans gone. That would still put you in the tax exempt window, right? So, but you have to consolidate your loans to make them eligible, if necessary, by the end of this year in order to have that count adjustment applied. Right? If I've been paying for 20 years, when will it end? Well, you've got 5 years left. Right? Graduated in 2006, right? You've got 8 years left. Right? It's the people that have been in repayment that these are the folks that I really didn't even know were out there, right? Until this one-time count adjustment was posted, right? And they started asking questions. I had no idea there was veterinarians out there that still had student loans from 1998, 1999, 2000, 2001, right? But they can be gone under this one-time count adjustment as long as you make sure your loans are the right type. And if they're not, you consolidate them by the end of this year. This also applies to newer graduates, right? So in one of the cases that I was illustrating before, right, when I look through these loans, this person graduated in 2018, hasn't consolidated their loans yet, has a break between when they borrowed for undergrad and when they borrowed for veterinary school, right? And they paid off some of these older loans. Now, this one's really particularly interesting because they can request a refund of the payment, reestablish this loan, consolidate it with the rest of their veterinary school loans, and add 3 years of additional qualifying time under the one-time count adjustment. Right? The closer you get to that 20 years, 25 years, depending on the plans that you're eligible for, the sooner your loans are going to be gone. Right? So that's how you can actually use this at a practical level. Right? If you know your loan history, you know the benefits that are out there, and you put yourself in a position to at least receive that count. See what that number is, right? You may be surprised at how close you are to forgiveness, or you may be able to knock a few years off of your repayment timeline just by taking advantage of this limited time benefit. How do we know if the one-time count adjustment has been applied, right? So if for anybody who hasn't already reached the threshold that would produce forgiveness, you won't see the count applied until next year, right? So they're working their way through the collection of people who have already exceeded the 20 or 25 years needed to have their loans forgiven now, right? So they're working on those folks first, and then anybody who has an amount less than the number of years that would trigger forgiveness will see that count adjustment applied next year. And then just like public service loan forgiveness, we'll all be able to see what our count is and be able to track it going forward so we know about when we can expect to receive forgiveness. How do you apply? You don't need to apply for the one-time account adjustment, right? You just have to make sure that your loans are the right type. If you have all federally held loans, you will automatically have the count adjustment applied. However, if you want the maximum count adjustment, like in a case like this, where you have multiple loans that haven't been consolidated, you're going to want to consolidate those loans before the end of this year, and then the maximum count adjustment will be applied for you when you receive that count adjustment. Do I consolidate through the studentaid.gov site? Yes, you do. So same place that we were in earlier, right? So if I come back to federalstudentaid.gov, you can do this electronically, right? And when you do that electronically, it'll look for the loans that you have in the system already, right? So under loan repayment, there's a consolidate loans option, right? And you can log in, it'll pull your loans into that consolidation, and that's what will consolidate your loan. Any other questions on the one-time account adjustment?
Yeah, there's a ton of questions at the very bottom of the Q&A.
Okay.
So they're kind of all piled there, and I can ask you them or you can read them, up to you.
I'm trying to see, let's see.
So a lot of people are asking if they've already consolidated, and if and how it impacts undergrad loans.
How consolidation impacts undergrad loan.
Yep. Does the one-time account adjustment count for undergrad loans? And
it does, right? So the one-time count adjustment is eligible for anyone who has federally held student loans, whether they're undergraduate loans or graduate school loans, right? Any amount of repayment time that you've logged on those loans will be counted as forgiveness eligible. However, you can envision a scenario here, right? So I'm going to come back to kind of our case that we're working from. When you borrow for higher education, you end up with a number of different loans, right? And all of those loans can have different years of repayment time on them, right? And rather than have a chunk of your loans with 20 years of qualifying forgiveness time and another chunk with 10, if you consolidate them, whether they're undergraduate loans or graduate school loans, if you consolidate them all together, that new consolidation loan will receive the maximum amount of repayment time of the loans included in that consolidation. Right, so if I consolidate loans that have 10 years of qualifying repayment time with loans that have 20 years of qualifying repayment time, whether they're undergrad or graduate school loans, the new consolidation loan is going to have 20 years of qualifying forgiveness time on it, which means I'm 5 years away from receiving forgiveness if I'm putting graduate school loans in there, right? So you really want to look at your loan history. Think about how much time you had in repayment on various loans. And if you haven't consolidated, this is the time to do it. There has never, ever been a better time to consolidate your loans. Right? And for some reason, as we've been talking about this now for a couple of years, there still is a significant hesitancy to consolidating your loans using a direct consolidation loan. And that part I haven't really quite understood yet, right? The consolidation loan is just a tool, right? And it really helps to clean up a lot of the messiness that has just resulted in a lot of student loan repayment frustration. And right now, consolidation can really clean up a whole host of messy loan histories and set you on a path to receive forgiveness way sooner than you may have thought you were otherwise eligible for. So if you have questions about that and you want to guide through that, then reach out, please, because we're happy to look at your loans with you and kind of say, yeah, this is, you're really going to benefit from this. But the pros significantly outweigh the cons of consolidating your loans now and through the end of this year. Right, so it's kind of one of those, again, magic wand, limited time opportunities that's been really complicated and hard to describe, but significantly benefits a lot of people.
And I'm sure you've said this, Tony, but if you are looking to consolidate in order to take advantage of that one-time forgiveness count adjustment, that does need to be done before the end of the year.
In order to get the maximum count adjustment, it has to be done before the end of this year. Right, if you have all direct loans now, you will receive a count adjustment. Right, but if you've got different loans that have different repayment timeframes and you don't consolidate them, you're not going to be able to fix that after this year. All right, so we also have some capitalization changes, right, as of July 1st, so just a few weeks ago. Right, we're not going to see interest capitalized in most cases going forward. Right, so this also begs the question, what's the difference between compounding and capitalization? And feel free to put that in the chat, right? Because this is another one of those areas that I see a lot of confusion around, right? One of the reasons people tell me most frequently that they want to get rid of their federal student loans as quickly as possible is because they can't stand them compounding, right? Your federal student loans do not compound. If they did, they'd be big trouble, right? But they don't, thankfully. Right now, they can capitalize, which means they take your unpaid interest and they add it to your principal for specific reasons, right? And that has, in the past, been led to a lot of just frustration and the feeling that you can never gain any ground on your student loans, and people that have been in repayment for 20 years or have balances that are higher than when they started. That's from capitalization, right? And there was a lot of different instances that would trigger that, right? So using a deferment or forbearance, or when you left school, or if you switched repayment plans, all of these were triggers for capitalization. But as of July 1st, a lot of those, where at least where they can, they are going to eliminate those capitalization events, right? So if I switch from pay-as-you-earn to revised pay-as-you-earn, or revised pay-as-you-earn to pay-as-you-earn, right, or save to the new IBR, I won't see any capitalization of my unpaid interest. Right? If I am first entering repayment, right, so those of you that have just graduated recently, if you haven't consolidated your loans, then any interest that you had on those would not be added to your principal. Now, I just spent a lot of time telling you that you would really benefit from consolidating your loans under the one-time count adjustment. And that's where sometimes we've got some, competing elements, a bit of a tug of war between the rules and regulations here, right? Right now, between now and the end of the year, consolidation is significantly beneficial, right? Because you can maximize that count adjustment and be done with student loan repayments sooner, right? But if you are a person who only has veterinary school loans and they've never been in repayment before, and there's really no benefit to consolidating them, right? If you don't consolidate them, then any unpaid interest you have will not be added to the principal. It'll just stay as unpaid interest, right? So, but again, there is a little bit of a tug of war here, right? There's competing elements. I told you to consolidate your loans for the one-time count adjustment. If that makes sense for you, so you can increase the amount of forgiveness time you have, then do that, right? That is a bigger benefit than preventing interest capitalization. But the good news going forward is we're going to also see fewer capitalization events. So there'll be less instances of your loan balances growing over time. All right. So
Tony,
here, somebody, go ahead.
I was going to say, there's been a couple of good questions in the chat about when I consolidate my loan, does that have an impact on my interest rates? Will they change? How does that work?
So they will calculate a weighted average interest rate, right? So whatever your interest rate is now, overall is going to be the same as your consolidation interest rate, right? So that's good news, right? They do round it up to 1/8 of 1%, but then after you're in repayment, you can set up auto pay and they knock 1/4% off as a discount. So it pretty much eliminates that rounding that the consolidation process does, right? But capitalization doesn't appreciably change your interest rate. It rounds it up to the nearest 1/8 of 1%. But if you can add 2, 3, 4, 10 years of forgiveness credit, that's way more beneficial than a 1/8 of 1% increase in your interest rate. Right. So I do, and I'm glad you brought that up because I do see a lot of people concerned with, well, why would I want to consolidate a 7.2% interest rate with a 5.3% interest rate loan? And it's because you're going to pay the same amount of interest regardless. Right. So better to consolidate them all, have the weighted average interest rate, take the 1/4% discount with the auto pay discount and the bonus forgiveness time that might come with that, like in this case, could be 3 years. Right. So that, the idea that if I keep my loans not consolidated, that I can pick them off individually over time isn't going to work out very well for your federal student loans. Right. So that's not a good reason to not consolidate. Right. And there really aren't very good reasons to not consolidate. Right. The pros significantly outweigh the cons in nearly every instance.
We actually just had somebody in the Q&A asking about, I thought that consolidation was bad because unpaid interest gets added to the principal when you consolidate. Can you kind of talk about that a little?
Yeah, it does, right? Consolidate. So that's what this was all about, right? So consolidation is that capitalization trigger, right? But consolidating your loans to receive more forgiveness time or to make them benefit from a newer or better income driven plan or public service loan forgiveness will outweigh the adding of the unpaid interest to that principal. In some instances, right? So if we talked about earlier that the old version of IBR is going to become obsolete, right? Old version of IBR, if you're going to switch from the old version of IBR to save, that's still going to be a capitalization trigger. In most of those cases, people that are using the old version of IBR, you have some older loans with repayment time on them. Chances are, if you consolidate them, you're going to increase that forgiveness eligible time. Either way, your unpaid interest is going to capitalize, but you're going to benefit from save going forward and the increased forgiveness time that you've earned, which is going to way outweigh the capitalization penalty, if you will, of the unpaid interest being added to your principal, right? And you can actually calculate that out. We haven't actually gotten to the loan repayment simulator yet, but you can compare that numerically, right? Depending on the plan that you're using or whether or not you're consolidating, we'll factor all of that in the loan repayment simulator so you can numerically evaluate whether or not capitalization is going to cost you more than the benefits you're going to realize from the one-time count adjustment or the new save plan, right? And just from the thousands of simulations that Rebecca and I have run, consolidation makes a lot of sense, right? I can't yet think of a scenario where I encourage someone not to, right? So numerically, it's always going to beat out that capitalization, right? So don't make that the reason why you miss out on some of these huge benefits, right? Yes, it sucks that they have to add your unpaid interest to your principal, but your loans and your finances are going to be better for it in the long term.
Yeah, I'd agree with that. I mean, I think Tony said it right. Like, it sucks, right, that they're going to add your unpaid interest to your current balance. But in running those simulations, that is what we've seen. And you can explore that yourself using the Student Debt Center tool. So start with that My Student Loans, upload your student aid data file, and then move that information over to the loan repayment simulator. I think, Tony, you mentioned that you haven't had a chance to look at that just yet.
Yeah, and I'm looking at, we haven't had a chance to look at the simulator yet, but I mean, I'm looking at this person who posted in here with 80,000 plus of interest. Wouldn't you be more concerned to consolidate that interest to your principal than gaining 4 years of repayment? And that's exactly what you can test, right? So I would encourage you to upload that file here and then send that information over to the loan repayment simulator. Right now, this particular case that we have up here doesn't have $80,000 of interest there, right? But whatever your circumstances are, you can put that in there, right? Put your principal, put how much unpaid interest you have in there, put the plan that you've been using, right? And how many years of repayment that you have. And if you're going to consolidate to receive an extra 4 years of repayment, make sure you add that 4 years to it and run that simulation and see what that's going to look like, probably for the new version of Save. Now, and we haven't gotten to some of the Save benefits yet, right? But one of the things that makes that capitalization less of an impact is that Save will not charge you any additional unpaid interest, right? If your minimum monthly payment is less than the interest accrual per month, the Department of Education will cover 100% of the interest that your payment is not covering under the new Save plan, right? So you will not see any more unpaid interest going forward, right? So think of it as kind of the last hurrah for your unpaid interest. When you consolidate it, it gets added to your principal, but it'll never get any higher, particularly if you're using the new Save plan, right? So that's, you know, I wish but if you tell us, the person who posted about the $80,000 of unpaid interest, if you tell us your principal or, you know, run a simulation yourself, you can see what that looks like numerically. I know it's you know, you definitely have to kind of do a big gulp to yourself. And yeah, you're going to add that to your principal, but chances are it's going to be way better for you on the other side.
One of the questions that I'm seeing a lot here in the Q&A, I've seen it a couple of times and upvoted, is if I have loans that I paid off, is there a way to include those in the consolidation so that I could take advantage of the one-time forgiveness account adjustment? What do I do with those loans that I've paid off?
Only if you paid them off during the forbearance benefit period, right? If you paid them off during the forbearance benefit period and you can request a refund of those loans, then request a refund. Those loans will be reestablished. Again, kind of another gulp, right? I'm going to voluntarily add loans back to my portfolio, right? But if that is an older loan that has a significant amount of repayment time that your overall portfolio can benefit from by consolidation, then request a refund, reestablish that loan, consolidate all of your loans, and you'll receive a higher count adjustment. If you paid them off before, then there's no way of reestablishing them. You're not going to be able to go back in time that far, unfortunately. How do you know if you have forgiveness after 20 years or 25 years? It depends on whether or not you have graduate school loans. If you have graduate school loans, you're almost always going to be in the 25-year forgiveness camp. The exception to that would be if you're eligible for pay as you earn, then you would receive forgiveness after 20 years. Okay, so I'm guessing, so this person said 379. So I'm gonna try to piece together a simulation here. Let's say you've got 379,000, you've got $80,000 of unpaid interest. We'll leave the average interest rate to about the same. We'll assume you've been using the old version of IBR, right? Maybe you've been doing that for 10 years, but you'd receive an additional 4 years of credit if you consolidate all of your loans, right? So 14 years is my repayment time, right? And I would anticipate receiving forgiveness after another 11, right? Because 25 years is the maximum repayment period based on what we just discussed. Now here, this is where I'm just going to have to just make things up, right? But your taxable income would need to be in here. So I'll just start with kind of the average, right? You want to increase that over time, however you think makes the most amount of sense. If you're married, right? Yes, no, how you file your taxes. If you file separately, whether or not you live in a community property state, if you've got kids, all of those things would be entered here, right? And if you've got a forgiveness savings plan already building, right, you can add that here. We can account for that as well. Whatever you're earning on that savings plan per year on average, what do you think that tax rate's going to be, right? I can run that simulation and I can see, yes, it's going to bump my balance now up to more than $450,000. And when I look at my remaining costs, right, under a plan like SAVE, presuming I'm going to abandon IBR 2009, I'm going to consolidate my loans to add that extra forgiveness eligible time, and I ride out SAVE, I'm projected to pay way less than I have remaining, right? Kind of back to that early comment I made about if you want to pay less than you borrowed, then income-driven plan is something that you need to get familiar with. And this is what we're seeing a lot with people who have some time logged in repayment that can benefit from moving over to the newer, more beneficial plan like SAVE, even with a really high balance, right? You're going to pay in total over the next 11 years a fraction of what remains. Right now, if you don't have a forgiveness plan in place, you're going to have to start thinking about that because you're running out of time, right? And if you have to pay a tax, that's going to happen soon, and you're going to have a pretty big amount forgiven, right? So you're going to want all of those things kind of go into that evaluation of what's the best repayment plan to choose. Right now, if we wanted to pretend like we're not going to use that plan, right, we're going to not consolidate our loans. Actually, it should have run IBR. Yeah, so if we stayed in IBR and didn't consolidate, right, I'd have to actually add some more time back to this. But you can see that it's still financially more beneficial to the tune of more than $100,000 to consolidate, take the capitalization hit, and use the newer, more beneficial plan, right? I mean, so that's kind of a perfect illustration of why, yes, it's scary to trigger that capitalization, but the new benefits are that much more beneficial.
We have one question that's gotten 33 upvotes. So
oh, let's do it.
Thanks, Jordan.
Give it a shot.
Yeah.
And it's an early one, but
Yeah.
Graduation year 2018. Should I switch from payee to SAVE? My salary has increased and I would like to make the lowest payments possible.
Great question. And that's that is actually the next section that I'm planning to get to. And that is what I call the pickle, right? So it really depends. So graduating in 2018, it's really hard for me to know which other repayment plans you're eligible for, right? So if Leah, if you're still here and you've uploaded your student aid data file and you know whether or not you're eligible for the new version of IBR or the old version of IBR, that would be helpful information, right? Because if you are eligible for the new version of IBR, the answer is simple, that you could use SAVE and then switch to the new version of IBR and still receive forgiveness after 20 years like you were planning to under pay-as-you-earn. That will save you the most money. But if you're not eligible for the new version of IBR, then you're stuck in the pickle, right? Where you have to choose between pay-as-you-earn, which has a 20-year forgiveness timeframe, or the new version of SAVE that has a lower minimum monthly payment, but will require you to be in repayment for 25 years total before reaching forgiveness.
Okay, they are saying that they are eligible for the new version of IBR.
Great. Well, then you are not in the pickle, right? Your decision
you have
is easy.
escaped the pickle.
Yeah, and you actually, because of the benefits we talked about with the capitalization changes, you can safely switch from pay-as-you-earn to the new version of SAVE without triggering any kind of capitalization event. You will have a lower monthly payment. If your payment is below the amount of interest that accrues, the government will cover all of that remaining interest, right? 100% unpaid interest subsidy. The kicker, which is kind of in the next section that we're going to get to, is you can only do that under the new save plan and switch back to the new version of IBR for a maximum of 5 years. Right, so there's a provision that came out when they finalized the rules for save that said, hey, we recognize that there's this difficulty for graduate school borrowers where, you know, they borrowed more, but they tend to earn more. So save is meant to be more beneficial, but yeah, we'd like you to be in repayment longer because we don't want too much of your graduate school loans forgiven, right? And we recognize that if you're eligible for IBR 2014, you can still get forgiveness of 20 years. We'll let you do that, but only if you do it within 5 years of using save. Right, so you'll only be able to use, but it's still a no-brainer, right? Strategically, you're going to want to switch from pay-as-you-earn, use save for the maximum amount of time you can, and if you're still projected to reach forgiveness based on your income and family specifics at that time, then switch back over to the new version of IBR before you reach that maximum time frame, so you can hit the forgiveness sooner rather than later. Right,
okay, so the person that asked the question, they're saying, so only be on save for 5 years and then switch to IBR.
Exactly.
The new IBR.
But technically for you, it's going to be 6 years, almost 6 years, right? So they're not going to start that 5-year clock until July 1st of 2024, right? So you can use save from the get-go once it becomes available here. So you would switch from pay as you earn, apply for REPAYE, which will become save. And then starting July 1st, 2024, they will start a clock that says you've used save for X number of months. And once you hit 60, or 61, you wouldn't be able to switch to back to the new version of IBR.
Okay, now we have multiple who are saying, but wait, I'm in the pickle. So
yeah, yes, and the pickle is the pickle for a reason, right? So you have to run your numbers, right? You have to run the simulation, right? Choose that you're currently using pay, right? And compare pay as you earn, hitting forgiveness at 20 years, even though you're paying a little bit higher monthly payment, against save, which has a lower monthly payment and the unpaid interest subsidy, but a longer duration until you hit forgiveness, and see which one wins. Right, but know that if you leave pay as you earn after July 1st of 2024, you can't get back in. Right, so hence the pickle. Right, this is the part I hate the most of how they did these changes. Right, is taking away pay like that, or putting people in a position where they have to kind of know this before July 1st of 2024. It really sucks. Right, that to me was just unnecessary. But it is what it is, right? So you do have an opportunity here to evaluate that and see which one's going to be better for you, right? So you've got a little bit, we've got a little bit less than a year to work your way through the pickle here and choose the plan that's going to make the most sense for you. Okay, any of those other ones that have 30 upvotes on them?
Yeah, let me take a quick look here. Yeah, that was by far the most. We do have, I mean, a lot of questions are like, how do you find the repayment plan with the lowest monthly payment? That had about 10 upvotes, so there's a lot there.
Yeah, so right out, I mean, that's somewhat of an easy answer, right? So Save is going to have the lowest monthly payment of any of the income-driven plans. Right now, your debt to income ratio is going to play a role there, right? So you could conceivably see, like Save doesn't have a cap on it. That the payment is always 10% of your discretionary income, right? So if you have a relatively low debt to income ratio, you can have a scenario where a standard 10-year plan payment would be less than Save. But in that situation, it's like, congratulations, you're doing just fine, right? So it's really not a concern there. But if your debt to income ratio is greater than 1, then Save is going to generate the lowest minimum monthly payment.
Yeah, the other one that got 39 upvotes was, can you talk about changing from payee to save plan? Would time forgiveness reset and the benefits of changing or staying in payee?
Yep.
2016 grad.
Great question, and no. So you do again, it's kind of one of those, we're in the magic wand zone, right? There is nothing that's going to take forgiveness time away from you right now, right? Nothing, right? If anything, you can only add more, right? Which is in a great position to be in. Switching plans never resets your clock, right? Now, in the past, consolidation has reset your clock, but that's changing too, right? So we're under this one-time forgiveness count adjustment, which is, again, all of that prior repayment time and more can be counted as forgiveness eligible if you consolidate between now and the end of this year. After this year, consolidating loans that have differing forgiveness times will do a weighted average, right? So we're actually not going to see the count reset ever again, right? So I know it's another one of those ones that is very, well warranted from past, but the changes in place now, you can be much less worried about losing forgiveness time, right? And be encouraged by being able to add more, particularly between now and the end of the year. All right, so say, kind of these questions that are coming up tonight, switch between pay as you earn and save and the pickle, right? It really depends on the plans that you're eligible for, right? So the pickle goes away if you are eligible for the new version of IBR. If it doesn't, you've got to run your numbers. And I've seen them fall out on both sides. I presumed that pay as you earn would still be better in nearly every case, but save really is that beneficial, right? So there are circumstances, and it's hard for me to tell exactly what drives it just yet. Generally speaking, if you have a higher debt to income ratio, you're going to benefit more from save than you will even pay. But it really depends on how much forgiveness time you already have logged. So at that point, it's up to you. Do I want to hit forgiveness sooner, which may require me to pay more in taxes, but I'll be done with my student loan sooner? Or do I want to extend it a little bit using save and pay a little bit less in tax at the end, right? So you have to run those numbers in the simulator and compare those and see which one, you'll one or two things will happen. You'll either look at it and it'll be obvious which one you should choose, or you're going to have a visceral reaction one way or another to the potential tax at the end. And that will usually kind of determine which one you're going to land on.
We did have a question in the chat just recently about, can my loan servicer tell me which plans I'm eligible for? I definitely encourage you to get that student aid data file from studentaid.gov and then upload it to the VIN Foundation My Student Loans tool. I'll post in the chat again a link to a video tutorial that helps to walk you through that. I wouldn't necessarily rely on your student loan servicer to tell you that information though.
Absolutely not. You have to double check that. There's and that's one of the reasons why we built the tools on the student debt centers, because the loan servicers are notoriously terrible at this. I would never take their word on which repayment options you have available to you. So double check that against this income-driven repayment eligibility tool, and double check us too, right? Every once in a while, this isn't 100%. Right? But it's probably in the 90s, right? So it's pretty damn close, right? And you're usually pretty good at identifying the ones that are not 100% accurate, but double check those things, right? And never rely on what your loan servicer tells you in terms of that. Like they have lied too many times in order to be able to be believed. So just make sure you're confirming those.
So I want to ask one question that's gotten 18 upvotes, because while it's a little bit off topic, it's something that I've seen a lot of people ask about. So I'm a 2021 grad. I'm planning for the tax bomb, but want to get my greatest return. Currently, I have my savings in a high yield savings account, but is there something better? And I know that you normally cover some of this, but I just want to make sure that we kind of touch on it.
Yeah, no, it's a great question. It's one that comes up all the time. And in the simulator, in the forgiveness planning module, there is a link to a blog post that we've written about crafting a forgiveness savings plan, right? And it's some general concepts and information just to try to, give you some ideas on how to think about it. Usually what you described is exactly what I recommend, right? Start with a high yield savings account that are yielding, decent interest rates these days, which is a great start. But at some point, you're going to look at that savings account and you're like, I think I can do better, right? And that's probably when you're ready to take the next step. And whether you're going to do that on your own or you're going to seek out the assistance of a certified financial planner to guide you through that, that's usually when I see people are kind of ready to take that next step, right? But look at that forgiveness planning blog, and you'll see some of how we talk about that forgiveness savings plan and developing that over time.
One thing that I also want to bring up is there's another question, because we've heard a lot that there are some colleagues that are struggling with passing navle right now. It's a shockingly high number that we're hearing about. So somebody asked, I'm struggling to pass my navle and have not yet received my salary. I'm getting paid hourly and it's not enough to pay all my bills in addition to monthly loan payments. Is deferment allowed for this instance? How long am I able to do this? Thank you. Grad year 2020.
Yeah, absolutely. So the great thing about the income-driven plans is that the payments are based on your income, right? If you haven't passed navle yet, then you're probably not earning an income commensurate with a veterinarian who has a license and is able to practice, right? Which means your income is lower, right? Which means your payments can be zero or very close to that. As a new grad, this is one of the things we talk about with students and new grads in the new grad playbook. We highly encourage everyone to file a tax return before they graduate, right? Whether they need to or not, you can still voluntarily file a tax return. That fourth year or the last year of veterinary school is usually quite, low on the earnings end of things, to say the least, right? So you're going to have a tax return that shows an income that's pretty damn near zero, if not negative. Right. So you can use that when you apply for your income-driven repayment plan. And if you apply for repay or save, right, that having a $0 payment while you're working on passing navle will assure that your loan balance does not change, right? Your $0 payment will count towards forgiveness and you will receive the 100% unpaid interest subsidy that comes with the new SAVE plan, meaning the Department of Education will pick up 100% of the interest that your payment is not covering, right? So that is the best move that you can make to kind of put your loans essentially in a state of suspended animation while still earning forgiveness credit so you can focus on passing navle, right? And then after that happens and you start earning an income that's more commensurate with a licensed veterinary practitioner, then you can reassess your loan repayment strategy. Right. So take advantage of these benefits that are baked into your student loans for exactly those reasons. Right. So that is a huge benefit that you can take advantage of while you're working to pass that navle.
Yeah, somebody just shared in the chat that for those that have not passed the navle, you can work with the USDA FSIS as a veterinarian with only graduating from veterinary school, no license or navle is required. That's good information for those.
Yeah, and also that position would qualify for public service loan forgiveness.
Yeah.
So, but you would still do the same thing, right? So use that tax return from when you graduated to get that $0 payment using SAVE. And if you're working for USDA FSIS, then apply for your submit the public service loan forgiveness employment certification form so you can start logging that credit.
Yeah, and all these links that we are talking about and Tony is showing, they will all be sent out in the email that we're sending out within the next couple of days with the webinar recording. We won't leave you high and dry. You'll also get this presentation that Tony has with all the links in it as well. So you will be getting all of these.
There's a really good question here. It's one of my favorites. Any recommendations on student loan specialists / advisors to help with picking plans based on family size and income?
This is one of those ones where, I mean, yes, you can find people out there. However, you have to start by being your own best advocate, right? You kind of have to scratch the surface enough here, and by just attending these things, you're already kind of getting, that first layer to know how to evaluate those folks that you might find, right? So there's, unfortunately, there is a dearth of knowledge around this particular topic and how to use it strategically. Now, there are people out there that can help you and do a very good job, but it's very hard to recommend, a specific person, which is why we're taking more of that, see one, do one, teach one approach, right? You really just have to know enough about this in order to protect yourself, not only to evaluate the loan servicers, but to evaluate the information that you receive from people that are trying to help you as well, right? So, you're going to have to be your own best advocate. But that said, you can put together a team of folks. And I saw another question in the panel come up about, does the simulator help with taxes? And it's like, yeah, we can't make it do everything for you, right? We can help it narrow down some numerical aspects of certain things, but then you may need to visit with an accountant to help put the bow on, whether or not it makes sense for you to file your taxes separately or jointly, particularly if you live in a community property state, right? But we can show you the projected cost differences to your student loans if you choose to file separately or jointly, right? But then you're going to have to visit with that tax professional to help put a bow on what those implications are from a tax standpoint, right? So you've got different things going on here. You've got to take care of your student loans using the most beneficial option possible, which is going to overlap with your tax planning, particularly if you're married, right? Whether or not you should file separately, file jointly, what that's going to do to your taxes, and then how is that going to interact with your student loans, right? Tax professionals can help immensely there for helping you understand the tax aspects of filing jointly versus separately. And then there's the long-term planning aspect, right? So we talked about forgiveness planning. If you do have to pay a tax, how do I, reach that target? And that's where those certified financial planners can help you piece together that target, right? So you can have 3 different resources and professionals helping you put all of this together: the tax professional, the certified financial planner, and then yourself using the tools on the Student Debt Center or somebody that you trust to help you navigate the student debt aspect of those questions, right? So I unfortunately, and I don't know, maybe we'll get there someday, there's not one tool that's going to answer all of those questions, but you can piece them all together using people who are subject matter experts in those particular aspects.
Somebody is saying, Nelnet says I have a payment due on 9/15. Would you know why that is?
It's wrong. Yeah, that's not correct. And I know Nelnet's my loan servicer, and I called them last week and was automatically frustrated. I mean, I don't, unfortunately, again, this stuff is really complicated, and they don't necessarily make more or less money if they can answer your questions accurately. So nobody's due to make any payments in September. Payments don't start until October. You'll see a statement probably in September. What we haven't covered though is the anniversary date, right? So it could be, and I'm not really sure, I'm speculating here, it could be that your anniversary date was maybe listed as September, in which case we know that that's going to get pushed to the following year, right? So another piece of information that you want to be looking for in your student loan exam, if you're using an income-driven plan, is your anniversary date, right? Or otherwise known as your recertification date, or your income renewal date. People call it a lot of different things, but when you use an income-driven plan, normally you have to provide some kind of documentation of what your income is at least annually, right? Now, nobody's had to do that during the forbearance period. And the way that they're unwinding this is they keep pushing that anniversary date into the future, right? So rather than make everybody renew now before repayment resumes, they're keeping your previous renewal schedule, but they're pushing it into the future so they don't overwhelm the loan servicers, right? Which they're already overwhelmed, just by nature of being a loan servicer. But your anniversary date is probably further into the future than you realize, which means your payment, this is particularly applicable. I saw these questions coming in through the the registration, right? I'm a 2019 or a 2020 grad and my payment was zero. And then the pandemic forbearance benefit started and my income's a lot higher now, but my minimum monthly payment is still zero. Great, let it be zero. And it'll probably be zero through 2024. And for some of you, maybe even into 2025, right? So you have to check what your anniversary date currently is in your file, use the rules that they've established for when you're next due to renew. Right? It won't be for anyone. It won't be any time before March of 2024, right? And whatever your anniversary date is, you keep adding a year to it until you get beyond March of 2024, right? And that's when your next renewal date should be, right? So I'm going to come back to one of our examples here of somebody who's using an income-driven repayment plan. Right, their renewal date. Oh wow, this is perfect, right? So their renewal date is actually listed at September of 2023, right? Nobody's required to renew right now and for 6 months after the pandemic forbearance benefits end. So I can add 1 year to this. This person's payment is going to stay at $446 per month until they're next due to renew in September of 2024. And this was coming back. Now we're kind of putting everything back together here. That's a strong case for this person to stick with the old version of IBR at least until next September of 2024 and then switch over to save, right? Because if they switch to save now, their income is increased enough where that minimum monthly payment would go, probably more than double. And there's really not a great reason to do that when you're still anticipating reaching forgiveness.
There was one question that I want to make sure that we've gotten a lot of questions about this. So as you guys can probably imagine, a lot of things are happening and we're trying to stay up to date and get things going. But there are questions about the save calculator being part of the loan sim.
Oh yeah, absolutely. So save is in the loan simulator.
And then
Right.
people, they were asking some questions about how it was coming across. Let me see if I can find that specific one.
While we're talking about this and Jordan looks for that, there were a couple of questions on my student loans and the pop-up that shows up if you do have some loans that might benefit from consolidation, and it says the current deadline for that has already passed. That deadline has been updated to the end of the year to consolidate and benefit from that one-time forgiveness count adjustment if you do have some of those older FFEL loan program loans. And so that's in the process of being updated as well.
Yep, absolutely. Thanks for pointing that out. And we're working on updating that date too. That we missed that one when they did the latest extension of that. So yeah, that date is in that pop-up is inaccurate. So December 31st, 2023 is the deadline for consolidating those older FFEL program loans and have them considered under the one-time count adjustment.
Okay, I'm still looking for it. We have 496 open questions.
Yeah, and I'm gonna pick one out here. So I see a 2001 grad who's been paying on FFEL program loans for 22 years, recently consolidated to direct loans with Mohila. Now what? Now you wait, right? Now you wait until that one-time count adjustment is applied, right? And you should see 22, maybe even 23 years, depending on when they apply that count adjustment, which means you're knocking on the door of forgiveness. You've got 2 years left until you reach forgiveness. However, after that count adjustment is applied, you're going to need to choose a qualifying forgiveness plan. Between now and when that forgiveness count adjustment applies or is applied, any repayment plan is eligible. Right? So you can consolidate, use the standard plan that they put you in for consolidation, and that will still be forgiveness eligible until the count adjustment is applied. Once the count adjustment is applied, then you're going to have to move that loan into a forgiveness eligible plan like Save, right? And ride out those extra 2 years in your case, or 3 years, until you reach forgiveness, right? But if you've already consolidated, right, wait. Right, and just choose the plan that results in the lowest minimum monthly payment, and that probably automatically happened as part of the consolidation loan process for you, Joanna, who posted that question.
Another good question here. How do you change your repayment plan?
You change your repayment plan and the studentaid.gov website, so loan repayment. I'm going to go income-driven repayment plans. And there's various different options here. I'm going to either recertify my income, right? If my renewal was due, but we know nobody's renewal is due now, unless your income has dropped, and it would result in a payment that's lower than you're projected to pay this October, or you can switch your plan.
I've got another one good one here. If I'm a 2022 graduate and haven't done a payment because of COVID, I'm guessing my payment is $0.
Ooh, it depends on what you did with your loans, right? And so, yeah, this kind of brings me to you're in the group that I'm one of the groups that I'm most worried about, right? So you guys graduated into the forbearance benefit period and weren't required to do anything with your student loans. And if you did nothing, then your first statement is going to be under that standard 10-year plan, right? Which could be a pretty big number depending on what your student loan balance is, right? So if you have done nothing with your student loans, then you want to come over to this application page and pick one, right? Now you're going to have to use some income documentation. It's either going to be the recently filed tax return you have, which is probably from 2022, or some kind of pay stub, or you can even self-certify. So you can just fill in a box that says how much your income is right now, and they'll calculate your monthly payment on one of the income-driven plans. Do I need to switch my plan from REPAYE to save, or does that happen automatically? If you're using REPAYE, it will automatically change to save. Now, I'm already using REPAYE. I don't know exactly how they're going to do that. That was what I was frustrated with when I called my loan servicer last week. So I called Nelnet and I started asking them. So it says here on the Department of Education website that if I'm using REPAYE, I'm automatically going to be put into save. And they said yes. And I'm like, okay, well, what's my payment going to be? They're like, oh, well, we're going to use your taxable income. I'm like, which taxable income? Right? I haven't provided any documentation in 3 years. Right. So I don't exactly know how they're going to calculate that payment just yet. So I'm still kind of waiting to see what that first statement is going to look like. But theoretically, if you're already using REPAYE, you're going to get rolled automatically into save. I just don't know if they're going to adjust that payment or not unless you do provide updated income information. This is a great question I see from Ruth that just came in. Will you please provide an email for me to ask questions? I am a single practitioner and cannot afford a VIN membership. So the student debt help that we provide through VIN Foundation on VIN is free whether you're a VIN member or not, right? We just need you to have a username and password, which you can create through VIN Foundation, so we know we're helping veterinarians only, right? Because this is it's a lot of work to open up to the world, right? So we're happy to help you. Just make sure you create that VIN Foundation username and password, and we can still get you some help over on the message board through VIN Foundation.
Yeah, and in case you're wondering how you create that, I just put a link in the chat. If you go to that student loan debt help page, that can start you with things. And also all these links will be in the email as well. So we'll help guide you through it.
Oh, this is another great question from Danielle, because this one comes up all the time too. So I am on the site looking to consolidate loans, and it says any payments I made on the loans I am consolidating before the date of consolidation will not count towards a number of years of forgiveness qualifying payments required for loan forgiveness. This is the opposite of what you mentioned. Absolutely, right? And it's because the one-time count adjustment is in direct opposition to what that consolidation language says, right? And I wish they would update that, but they didn't, and they don't, because again, they are waving magic wands here and making exceptions to a lot of rules that have been in place for a long time, right? But the one-time count adjustment language, and that there's links to that on the Department of Education website. We have links to that in the blog post that we have that covers the one-time count adjustment as well directly refutes that, right? So don't trust that, right? Again, you're going to have to trust me on that one, but the people that we have counseled through this who have consolidated their loans and have reached that 25 years of repayment are receiving forgiveness, right? So you're at some point, you're going to have to believe one or the other. I would encourage you to believe what we're telling you just based on our experience here and what the one-time count adjustment language says, but you know, it ultimately is up to you. So if you switch plans, are you then required to provide income recertification? Unfortunately, yes, right? That's another part of the, let's call it a smaller pickle, if you will. If you switch plans, you're going to lose the monthly payment you have, right? And it's going to ask you for current income information that will generate a payment that might be higher than the current payment that you have, which is why you may want to wait until a later date to change your repayment plan if it's appropriate. Okay. Wow. All right. For consolidation, I selected the same old IBR. Will I still be able to switch to save later? Absolutely. Once that consolidation loan is processed, right, and done, and you get a statement for what that monthly payment would be coming up here soon, you can switch to that new repayment plan if you'd like to at that time. Even if your consolidation is still being processed, I wouldn't switch plan yet. I would want to wait until I got confirmation that consolidation loan is done, so they know exactly what I'm trying to do.
When you certify your income, is this based on adjusted gross income if married and filed jointly? I think we should probably discuss that in general as well.
Absolutely. So yes, if you file your taxes jointly with your spouse, there's two possibilities of income documentation for you to use. Your tax return AGI that's going to show both you and your spouse's combined adjusted gross income, or you can both provide your respective alternative documentation of income, right? So pay stubs or something else that documents your taxable income, right? But if you file jointly, you're going to have to provide that for both you and your spouse. There's no way around that. Now, if you file separately, you only have to provide that information for yourself.
This is a good one. If I'm currently on maternity leave, can I certify my current income now and have a low monthly payment until next year?
Absolutely. Run and do that, right? That is an excellent strategy. It will set your payment to something based on your maternity leave income, maybe even zero, right, for the next 12 months.
Right. And I mean, that concept applies for anytime your income goes down, right? Not just like a maternity leave, but if you have a decrease in income that's going to make you have a lower student loan payment, go ahead and submit that information.
Yep, and you do that here. You do the recalculate my monthly payment, right? So if it's otherwise outside of a renewal period like we're all in right now, right? Nobody's required to renew their income information because of the forbearance benefit. But if you would have a monthly payment due when payments resume in October and you're on maternity leave, you can have them recalculate your monthly payment, right? Signifying that your income has decreased since the last time you have provided that information, right? So that's how you would have that payment recalculated. All right.
Do you want to keep going, Tony? How are
I'm
we
gonna. I'm looking. I'm sorry. I was just started looking at some of the questions here, but
yeah, I know. You can get lost.
There's only a couple.
There's just a couple. You guys are doing a great job with questions. Somebody asked if we're going to share the Q&A list. That would probably be a bit overwhelming, but we will share. We will do our best to start sorting through this information and these questions and sharing. We'll work on combining them and gathering them. And a lot of these questions are questions that we get a lot. And so a lot of our links will help answer a lot of these questions.
There's one here that says, so if I work for a profit organization up until I retire, I will not qualify for forgiveness and would have to keep paying all my loans until I die.
No, thankfully not.
They will go
So
away.
They will go away. So that's what the difference between public service loan forgiveness and income-driven repayment forgiveness, right? So the longest you can be in repayment now is 25 years, right? If you're using an income-driven plan. But with the one-time count adjustment, again, magic wand, right? Any prior repayment time, regardless of who you're working for, as long as your loans are set up to be counted under the one-time count adjustment, right? So a federally held loan, a direct loan, consolidated loan, optimally will give you the maximum amount of forgiveness time, right? If you, once you hit 25 years, you're done, right? Or you've paid them off before that, right? So that's the, you know, the scenarios that can play out with your federal student loans. Or if you qualify for public service loan forgiveness, they'll be gone in no more than 10 years.
Okay, there's a couple more of the highest up votes here. So grad 2020, haven't made any student loan payments yet due to COVID, consolidated my loans, and on the payee repayment plan, should I switch to save? I think your answer is 100% always switch to save. Also have these past 3 years counted towards my repayment years, even though I technically haven't made a payment yet.
Yes, so if you graduated in 2020, now I would want to know, are you eligible for the new version of IBR or not, right? If you are, which being a more recent graduate makes it more likely that you would be, but if you were kind of a career changer or had some time between undergrad and veterinary school, you could very well not be eligible for the new version of IBR. But if you are eligible for the new version of IBR 2014, then it is a no-brainer, right? You would switch from pay to save for at least the next 5+ years, and then reassess whether or not it makes sense for you to switch to the new version of IBR to receive forgiveness sooner, or ride out save. Right. So but the 3 years that your loans have been technically in repayment, but under the forbearance benefits, would be eligible for forgiveness credit after your grace period ended. Right. So if you graduated in 2020, let's say it was May, because that's when most of the US vet schools graduate, then your forgiveness credit would have started from about November, which means you're not quite to 3 years of forgiveness qualifying credit on those loans from veterinary school. But if you had loans from before veterinary school, you may want to consider consolidating them to see if you might even be able to boost that forgiveness time beyond that 3 years under the one-time count adjustment.
Okay, the next most upvotes, 2021 grad, what is the best repayment plan for someone that has not had any payments yet, associated private practice?
Again, that one's going to be almost an identical answer, right? What did you do with your loans since you graduated?
Mm-hmm.
Are you eligible for the new version of IBR? Do you have any prior loans that could have some repayment time on them that could benefit from consolidating and receiving the one-time forgiveness count adjustment, right? But you should have at least 2 years or close to 2 years of forgiveness credit, even if you haven't chosen a plan, right? But those are the steps I'd be walking through to then decide, should I choose save? If I'm eligible for the new version of IBR, I'm automatically going to get started with save, and then reassess as I approach that 5-year maximum window to see if I need to switch to the new version of IBR. Now, if I'm not eligible for the new version of IBR in that scenario, then that's the pickle, right? So I have to decide between now and next July 1st if I want to choose pay as you earn and use that long term, or if I'm okay sticking with save.
Okay. Grad 2015 from vet school with 375K, made all payments on time. Now I owe 440K thanks to interest Is the Obama forgiveness still happening? But then I pay 30% as income tax, which puts me in debt to IRS for life.
Yeah, so that one, again, that's one where I would want to run a simulation, right? And I think, based on your graduation year 2015, you're still kind of, you may be in the pickle there, right? Do I want to receive forgiveness sooner, in which case I'm going to have a pretty big tax that I'll have to pay, that might be difficult to manage in that shorter forgiveness window, but that's where SAVE can really help. One of the things we haven't talked about with SAVE that is probably the most beneficial aspect of it is it pretty much caps the amount of student debt you'll have forgiven. Right. So if you're really worried about the tax at the end, then SAVE is the plan for you. Right. Because we know that you cannot have any more forgiven than what your current balance is right now. Right. And based on the numbers that I heard Jordan read, that you've got $400,000 of student debt, chances are whatever your income is, your payment's going to be less than the interest, which means you're going to benefit from the unpaid interest subsidy that they provide, which means you're guaranteed to not see your loan balance grow anymore. Right. So if I'm really worried about the tax and I want to give myself a little bit extra time to plan for it, presuming that I'm going to have to pay that tax at the end, right, I'm going to use SAVE, right, because it gives me more control over what that tax is going to be at the end. Hopefully that makes sense. We're going to start talking about that more in some of the materials that we put out around SAVE and strategically evaluating some of these repayment benefits going forward. But that's, to me, one of the biggest benefits of SAVE is that it takes the mystery out of what the maximum amount would be forgiven. And it's because of that 100% unpaid interest subsidy.
Okay, those are, I would say, the most highest up votes.
Cool. Well, you guys tell me. I mean, we've been doing this for 2.5 hours here. I think, I mean, I know there's a lot of questions, and we'll try, and what we've done with the past on some of these is try to, post some of the questions and answers that we've come up with. And for those of you that have posted questions here that we didn't get to, we do try to address those in some manner. But I will also kind of push you towards the help here, right? So some of these, in order to really critically evaluate your circumstances, we're going to need you to, go through the help process, right? So if you go to this help page on the foundation website, we're going to ask you to complete a student debt and income signalment form. It's going to ask you a lot of questions. That'll get posted on the message boards anonymously, and then we work through your circumstances and kind of lay out some of those more detailed things that we've been talking about this evening. And then it gives you a place to return back to, review that, and ask questions as your circumstances change, right? So if you visit with a accountant, and I think I saw somebody in here said they visited with a financial planner and they're really trying to get them to pay their loans back as fast as possible. And that's the, like, and I think you asked, how do I get them to realize the benefits of these plans? And it's like, well, you may need to find a different financial planner in that case, right? Because that's unfortunately some of the problems we run into, is the ones that either don't know strategically how they work or haven't kept up with the changes. They tend to make recommendations like that, right? So, and that sometimes might not be to your benefit. So, if you face something like that, again, we can give you some information to help process some of this stuff on the message boards, give you some links to simulations that you can sit down and visit with your accountant and your financial planners, and links to the rules and how these things work. And generally, the ones that are more open-minded come around because you've got more money to work with, right? Which helps you and it helps them too. So usually they come around, right? But if it's a matter of information and trying to help answer some of those questions, then we can certainly help do that through that personalized help in the message boards.
Yeah, and just a reminder, everybody, we still have over 340 people here. We will be sending you out an email within the next couple days. I know we have a ton of questions, a ton that we haven't gotten to yet. We've hopefully gotten through a lot of them, and we will continue to answer them. And so keep a lookout for that email. It's from studentdebt@vinfoundation.org, and keep a lookout in your spam as well. We'll send a recording. We will send a link to Tony's presentation, which has all these links, and we will also send a bunch of other helpful links. I really encourage you to also check out the blog on the vinfoundation.org website. There is a ton of content there. You can use the search feature and find blogs in there. We have covered a lot of these topics in there as well, and we are going to, as Tony mentioned, continue to update our resources.
Absolutely. And I mean, I do, you know, I should have not looked at the question panel again, but I see a couple. I see a couple of there.
It's hard not to.
I know.
Like,
I just can't pass up. And it looked like they posted them relatively just a few minutes ago. So I feel like if I answer it, it'll help.
Go for it.
So yeah, Jeff posted a comment here. So it's referring to the student aid website calculators. So yeah, that's another reason why we built the loan repayment simulator, right? So that unfortunately that student aid calculator, I think they call it a simulator now too, is just not flexible enough, right? It kind of really gives you a high level overview of what your payments would be right now if you were starting from zero in repayment. Their calculator doesn't account for any forgiveness time you might have yet, right? And that was one of the main reasons why we had to build the simulator, is to build in the flexibility that the calculator didn't have, so you can actually make more informed decisions, right? So you can certainly start with that thing, but it really only is designed for people who are starting repayment from scratch. And the one-time forgiveness count, I keep beating that drum. I mean, nearly no one is starting from scratch right now, right? So it's just not adequate enough. So I would encourage you to seek out tools, or if you, at worst, I mean, you can build your own spreadsheet and work through those numbers yourself. But the simulator is there to really help you establish that baseline and start to compare those options. I see a really good question here too from Glenn, who's a financial planner, the one dedicated to the Colorado State students, one of the only schools that actually has a dedicated financial planner for the veterinary school specifically. And I've been working with him a lot lately on understanding the ins and outs of the plans. But he asked a great question here. So in the event that the tax is larger than feasible, can you switch to a 30-year plan in, say, year 23? So I would not encourage anybody to do that, right? So you probably could. However, you're going to end up paying a ton more, and you're going to be in repayment a lot longer in the event that you experience student loan forgiveness and it is taxable at the federal level, and it's an amount that you cannot afford. There is an escape hatch, right? There's an insolvency system in place for any canceled debt that is treated as taxable income. If it exceeds your ability to pay, right? So they measure your solvency, your assets against your liabilities. And to the extent that you're insolvent, including that amount that's forgiven, you would not have to pay any tax to the degree that you're insolvent, right? So there is an escape hatch for the tax if you can't pay it through those insolvency provisions. But the downside of that is you're insolvent, right? That's not a goal that anybody should be shooting for. So hopefully you've got it. If you anticipate hitting a tax, you've got enough time to plan for it, right? So that's one of the reasons too why that tax exemption between 2021 and 2025 is so beneficial. And one of the reasons why I really think they'll probably have to extend that at least another 5 years, because there are a lot of people that are going to have a lot of debt canceled quickly that may not have the ability to save up for that, right? So rather than, put them all into insolvency, they're probably going to keep that exempt, right? But for right now, the exemption only applies for people that are receiving forgiveness between 2021 and 2025. If it does appear that you're going to have an amount forgiven that you can afford to pay tax on, you're better off going the insolvency route than switching repayment plans and trying to, pay for another 20 years or something like that on your student loans. But it's a great question, and it comes up quite frequently, again, mostly because that tax is just so scary for so many people. But to the extent that you get ahead of this sooner rather than later, you can more than plan for that tax and be able to cover that when and if it happens for you.
Your
All right.
call, Tony, if there's other ones.
Yeah,
you wanna go
no,
over.
I'm gonna stop looking because
Okay.
we probably need to stop and let people get on with their evening. But
Thanks,
we'll continue.
everybody.
Yeah.
We'll be, one person asked a question that they want to share this with colleagues. Absolutely, please share it. We will be putting this recording on YouTube. We will be having a page on our website that you can share that will have a link to this. We'll have this recording embedded in there, as well as additional helpful information and a link to this presentation. The VIN Foundation's goal is for us to help as many colleagues as we can. And we're always looking for ways to improve. So we want your feedback. So please share this and keep a lookout for the Student Debt at VIN Foundation email that's going to be coming your way. And thank you all for spending this time and wanting to do good by your student loans. And we're here to help. Anything else that Becca or Tony that you guys want to add?
No, thank you, Jordan. Thank you, Becca, for helping with all of the questions and jumping in and making sure that we got through as many as we could. And we'll keep doing these sorts of things. We know that there's just constantly questions that are going to be more that come up as interest starts and payment starts, and it's going to take some time to kind of get to a new student loan repayment normal. And the good news is, we've got a lot of information and resources and a lot of experience with this to share and help to guide you through it. So please don't feel like you can't reach out for help. And if you're struggling with any of this, please reach out and we'll do what we can to help.
Yep.
Yeah,
and again, all of this is free and available to you guys. So nothing's behind any sort of paid wall.
And I just wanted to say, definitely stay curious, ask questions. If something that your loan servicer says doesn't seem to pass the sanity test, reach out, let us know. Because we are here to help, and there's a lot to learn and a lot to know. So that's what we want to help everyone with. And just, kind of, if you haven't been in touch with your student loans in a while and haven't really been paying attention to them, now is definitely the time to tune back in.
Oh,
all right.
cool.
Thanks, everybody. Hope you have a great night. Thanks for sticking in with us, and you'll hear from us soon.
Absolutely.
Thank you.
Thanks, everyone.